Good evening, all of you, dear students. Our new chapter, Working Capital Management. This is our new chapter. Yes. This is our chapter. First of all, this in this particular topic, you have to understand what is this term working capital. The mathematical formula is current assets minus current liabilities. Simple. Current assets is simply known as gross working capital. Whereas current assets minus current liabilities, the whole term is simply known as net working capital. Generally, net working capital is the amount which is being invested by long-term investors. That means this net working capital is purely financed out of long-term sources. Okay. So your total current assets are generally financed out of two sources. One is long-term sources, other one is current liabilities. If you deduct the current liabilities portion, the balance worth of current assets are completely financed out of long-term sources, which is known as what? Net working capital. Actually, in simple terms, working capital means it is a minimum amount which is required to be maintained by every firm to meet its day-to-day operating expenses. This is the regular definition of the term working capital. Now, in this particular area, actually, we need to handle these important areas. First one, estimation of working capital requirement. This is our first area. Wait. Estimation of working capital requirement. Second one, operating cycle computation. Next one, debtors management. Cash management. Inventory management. Nothing but materials chapter in your subject costing or cost accounting. Next one, creditors management. In fact, debtors and creditors management, you have to understand both of these concepts simultaneously. Better write there. Creditors, debtors management and creditors management. Yes, these are the important areas we need to understand, and there are some theoretical aspects also. So first of all, let us handle the most important area called problematic part. So let me start with the first concept, estimation of working capital requirement. That's our first concept. Estimation of working capital requirement. See, under this concept, first of all, we should have an idea. Every firm should maintain sufficient working capital to run their business smoothly. Maintenance of working capital means maintenance of stock of raw material, stock of work in progress, stock of finished goods, debtors, and then sufficient cash and bank balance. So to finance these items generally will dependent on the short-term sources called current liabilities, creditors, outstanding wages, outstanding overheads, and sometimes we can maintain bank overdraft also. So if you deduct such current liabilities from current assets total, the balance is your net working capital requirement. So here in this context, estimation of working capital requirement is nothing but net working capital requirement. Now, the question is, why should I maintain stock of raw material? Every firm should maintain stock of raw material for to support the uninterrupted production process. So for running your production on continuous basis, you should maintain sufficient stock of raw material based on your inventory policy. Second one is, every firm should maintain stock of work in progress because of the processing process which is inherent in every manufacturing concern. So due to processing period, you are supposed to maintain sufficient stock of work in progress. Every firm should maintain stock of work in progress, sufficient stock of work in progress also based on the processing period. And every firm should maintain stock of finished goods. The question arises, why should I maintain stock of finished goods? To meet regular demand and sudden demand from certain category of customers, every firm should maintain sufficient stock of finished goods. So why should I maintain debtors? Say, when we are working in a competitive environment, we are supposed to sell some of our goods on credit basis to some of the customers, reputed customers. So because of that reason, you have to maintain debtors. So when you're selling goods on credit basis, the credit sales results in debtors. So you have to maintain some amount of money in the customer's hands also, which is nothing but investment in debtors. Okay, this is the next investment. So for meeting regular day-to-day operating expenses, I should also maintain sufficient cash and bank balance. So to finance these items, I'll maintain, I can have short-term sources like creditors for raw material, outstanding wages and outstanding overhead expenses, along with what bank overdraft sources. So the question is, how to estimate this working capital requirement? How to calculate investment in stock of raw material, which is supposed to be maintained throughout the year. Now I'm going to prepare the statement. In this statement, I'll write all the current assets components and current liabilities components, which are part and parcel of your estimation of working capital requirement. My dear students, the point is, any component that you're writing in this statement should be maintained throughout the year. That's the rule. Okay. So if I calculate investment in stock of raw material, such stock of raw material should be maintained throughout the year. Stock of work in progress, stock of finished goods, debtors, cash and bank balance. Those numbers should be maintained on an average throughout the year. So that's why you have to invest. And then even current liabilities also, those are the short-term sources available throughout the year. So this is the rule. Any item that I'm writing here, such items must be maintained throughout the year. There is a lot of conceptual background behind this. I'm just taking only the concepts and I'm just taking only the formula set here because we have only some limited time here, right? The first area is investment in stock of raw material. How to calculate this? Simple. Write the budgeted production units into raw material holding period divided by 360 days. For the sake of convenience, I'm taking number of days in a year as 360 days into raw material cost per unit. This is our first formula. Investment in stock of raw material formula. Write the budgeted production units, multiply that number with raw material holding period divided by 360 days into raw material cost per unit. That gives you investment in stock of raw material. This is the first component. Next one is investment in stock of work in progress. Investment in stock of work in progress. See, before writing this investment in stock of work in progress, let me tell you one important point. Investment in stock of raw material means that portion of stock of raw material you are supposed to maintain throughout the year. Actually, say for example, if you take 360 budgeted production units, and your holding period is 30 days. So I'm taking the numbers here. 360 units as your budgeted production units, and raw material holding period is 30 days divided by 360 days, 360 days. and raw material cost per unit is 100 rupees. So if you multiply this number 360 into 30 by 360, I got 30 units. Such units must be maintained throughout the year into 100 rupees. So 3000 is the amount of stock of raw material that I should maintain throughout the year. In case if you consume the raw material from the stores, you have to buy the raw material immediately. On progressive basis it will happen, but on an average you are supposed to maintain 30 units of stock of raw material. If you consume 1 unit of raw material, you should buy 1 unit of raw material. So at any point of time you should maintain 30 units of stock of raw material, which is supposed to be maintained throughout the year. That means your investment in stock of raw material is 3000 rupees at any point of time in the year. Okay, this is the first investment component. The second investment component is investment in stock of work in progress. The question is, how much money is going to be blocked in the units which are in process. See, when the units are in process, along with the material cost, a portion of labor and manufacturing overhead cost will be blocked in your work in progress. How much portion of material cost and how much portion of labor and overhead cost is going to be blocked? You have to bifurcate such components, cost components, which are loaded in your work in progress investment. So I have to write raw material cost, labor cost, overhead cost. Let me write the component. First of all, the raw material cost. Here is the first component. See, the formula is very simple. Budgeted production units into WIP-HP, work in progress holding period, which is also known as processing period, divided by 360 days into raw material cost per unit. Then you'll get an amount that should be written in inner column. Don't write it in outer column, because I have to write the remaining two components. One is direct wages or wages cost. I can write wages cost actually. That's better. The wages cost. This is your second cost component. When it comes to wages cost, the formula will be changed slightly. Budgeted production units into the same term, work in progress holding period divided by 360 days into, since it's a wages component, you have to write wages cost per unit. Wages cost per unit of product. See, this is not the end of the story here actually. Material cost will be blocked 100%, but when it comes to wages and overheads, if 100% wages and overheads costs are incurred for units, then such units must be 100% complete. That means such units must be of finished goods. So when we are talking about stock of work in progress, definitely those units are not 100% complete with respect to each cost component. So generally we'll take raw material is 100% complete. When it comes to wages and overheads, I'm going to take a partial percentage of wages and overheads costs. So how much percentage of wages and overhead costs I should consider? The answer is, you should check the percentage of completion for wages and overhead costs for work in progress with respect to work in progress and the examination problem. In case if the percentage of completion is given in the problem, write those percentages directly. In case of such percentages are not given, then I'll always assume that raw material cost is 100% complete, wages and overheads costs are 50% complete with respect to work in progress units. That means here I'm going to multiply this number with 50%. I'm going to multiply this number with 50%. This is my second cost component, dear students. This is my second cost component. Okay. This is my first cost component. This is my second cost component, which is loaded in your stock of work in progress. Now I'm writing overheads. Overheads, the same formula, budgeted production units into work in progress holding period divided by 360 days into overhead cost per unit. See, just like wages, here also I'm going to take 50% completion with respect to overheads also. for work in progress units. See, these percentages may differ. That means the 50% that you have applied to wages and overheads may differ based on the problem, based on the information which is given in the problem. In case if these percentages are given as 40%, you have to write those percentages. If those percentages are given as 30%, you have to write those percentages only. Generally, they'll give you the percentages applicability to conversion cost. Conversion cost means wages and overheads costs are the conversion expenses which will convert raw material into finished goods. So for conversion cost, they'll give you the percentages. Such percentages must be considered. Sometimes the percentage of completion can be given even for raw material also. So in that case, you should apply percentage of completion even for raw material also. Accordingly, you have to calculate investment in stock of work in progress. Now, we have successfully written all the three cost components in the stock of work in progress and I've given you formulas. Now, get the total of it. So, what is the total here? Raw material component, wages component and overheads cost component which are loaded in investment in stock of work in progress. 1 plus 2 plus 3. Okay, 1 plus 2 plus 3. This is my investment in stock of work in progress. Okay, and your study material, they have given a simple formula called budgeted production units into work in progress cost per unit into work in progress holding period divided by 360 days. That is the formula they have given. The question is how to calculate work in progress cost per unit. In such work in progress cost per unit, raw material is 100%, labor and overhead is generally 50%. In that way, you have to calculate. Instead of that, you better bifurcate these work in progress components into raw material, wages, and overheads. It's a better presentation. Okay, and convenient also. Now, let me go for the next component: investment in stock of finished goods. Wait. Investment in stock of finished goods. The formula will be budgeted production units into finished goods holding period divided by 360 days into cost of production per unit. Cost of production per unit. This is the formula. So what is the formula? Investment in stock of finished goods is equal to budgeted production units into finished goods holding period divided by 360 days into cost of production per unit. You can observe this cost of production per unit from the cost sheet, or you can collect this information from the cost statement which is given in the problem. This is my third investment. Now I'm moving to the next area, investment in stock of, investment in debtors actually. That is your next area. Investment in debtors. The formula is, see, for debtors I must consider credit sales units. So budgeted credit sales units into debtors collection period DCP divided by 360 days into cost of sales per unit. See, for debtors I'll consider total cost per unit or cost of sales per unit. So this is my investment in debtors. So what is the formula for investment in debtors? Budgeted credit sales units into debtors collection period divided by 360 days into cost of sales per unit. This is my next investment. So we are taking all the formulas, dear students. Cost of sales per unit means cost of sales which is calculated from cost statement. Okay. The next one is investment in debtors. Investment in cash and bank balance. Investment in cash and bank balance. This is my next investment. Get the total. Then we are going to get gross working capital generally. gross working capital. This is A. And now I'm going to define current liabilities. Current liabilities. Let me write the creditors for raw material. This is my first financing component. Creditors for raw material. I have to write the right component is budgeted. Actually, you should write credit purchases here. But in the study material, they've given you the formula in a different way. In the study material, they're taking budgeted production units only for creditors also, because actually we are supposed to take budgeted credit purchase units. That's the right term, but still I'm writing the same formula given in the study material. Yes, budgeted production units. Budgeted production units into CPP, creditors payment period. Creditors payment period divided by 360 days into raw material cost per unit, because creditors will be calculated by taking raw material cost per unit. Because for raw material cost only, we are going to have creditors. So this is your first financing component. Creditors for raw material. It's a short-term finance to maintain my current assets. The next one is outstanding wages or accrued wages. See, this can be calculated by using the same formula, but instead of taking CPP, I'm going to take time lag for wages. Okay. So the formula is budgeted production units. Budgeted production units into time lag for wages divided by 360 days into wages cost per unit. Wages cost per unit. This is a formula. Okay. This is my outstanding wages cost. So how to calculate this? Budgeted production units into time lag for wages divided by 360 days into wages cost per unit. The next one is outstanding overheads. Outstanding overheads. So the next one is outstanding overheads. Same formula set. Budgeted production units into time lag for overheads. Time lag for overheads divided by 360 days. Instead of taking 360 days everywhere, you can take 12 months also. If the numbers are given in months, you can take weeks also, 52 weeks, in case the inventory norm, nothing but time lag for wages or overheads or inventory, raw material holding period, work in progress holding period, finished goods holding period. If these numbers are given in weeks, then the denominator must be 52 weeks. If these numbers are given in months, then the denominator term must be 12 months. If the number is given in days, you should consider 360 days. Okay. So outstanding overheads, overhead cost per unit. That's it. Okay. So budgeted production units into time lag for overheads divided by 360 days into overhead cost per unit. That's it. So with this, we have taken all the current liabilities. We have GST also in the material, in the study material. I can take that directly from the study material. I'm just taking the total here, current liabilities total. This is the general format actually. Net working capital. A minus B, total current assets minus total current liabilities, or gross working capital minus current liabilities, that gives me net working capital. See, this is my estimated working capital requirement, which may be deviated from the actual requirement sometimes because of the increase in the cost of the raw material or wages or overheads. That means you are estimating some cost components for the future. Accordingly, you are estimating the working capital requirement. In case if your actual raw material costs or wages costs or overheads costs are deviating from your budgeted cost statement, then you may need additional working capital, which you may not expect actually now. So because of this reason, I'm going to maintain some extra margin, which is known as safety margin, or with this is also known as provision for contingency. Provision for contingency. This is additional working capital. Provision for contingency. This is the additional working capital that I'm going to maintain. Say for example, it can be 10% additionally or 15% additionally or 20% additionally based on your estimation. So add accordingly such safety margin, then finally you're going to get total net working capital required, including safety margin or provision for contingency. Okay, this is the final statement. Actually, the estimated working capital requirement can be handled in these 3 steps. In step number 1, you need to write inventory norms. Inventory norms means raw material holding period, work in progress holding period, finished goods holding period, debtors collection period, creditors payment period, time lag for wages, time lag for overheads. These numbers you have to write it in the step 1. Okay. Once it is over, then go for step 2. In step 2, I'm going to prepare cost statement. It's a per unit cost statement. That means you have to write raw material cost per unit, wages cost per unit, overhead cost per unit. Okay, write these cost per units, cost per unit of each cost component. Then go for the step 3. Before going for step 3, sometimes this cost per unit statement can be prepared as a total cost statement by bifurcating your overheads into factory overhead, administration overhead, and selling and distribution overhead. So I can prepare full cost statement also. So based on such cost statement, I have to estimate the working capital requirement. So sometimes I may need to prepare full cost statement. Okay, full cost statement, and that's what I need to prepare sometimes. That means direct material consumed, direct wages, direct expenses, prime cost, add factory overhead, gross works cost, add opening and closing, add opening work in progress, deduct closing work in progress. You're going to get net works cost. Then add administration overhead related to production or administration overhead. Then I'll get cost of production. Add what? Opening stock of finished goods less closing stock of finished goods. Then you'll get cost of goods. So then I'll add selling and distribution overhead along with sometimes general administration overhead can be added. Then I'll get cost of sales. Then add profit sales. See, from this cost statement only, I'm going to pick the numbers for estimating the working capital requirement, which I'm going to prepare in step number 3. That is step number 3, estimation of working capital requirement. Estimation of working capital requirement. This statement should be prepared based on the format that I've given just now. Okay. So just now we have discussed about this cost, this particular working capital statement. The statement can be used in step number 3. Okay. With this, the estimation part is completed. So while estimating this working capital requirement, you should consider some of the points. What are the points, sir? See, in cost statement, if you find depreciation in the overhead, please exclude it. Depreciation should be excluded. Then accordingly, this depreciation must be excluded from working capital requirement. Your stock of work in progress, if at all if your stock of work in progress is loaded with depreciation, then please exclude it immediately. If your stock of finished goods is loaded with depreciation, exclude it. If your debtors is valued at cost of sales, then such cost of sales must be excluded with depreciation. So these are the points you should remember. Whenever you are seeing the depreciation, that should be excluded from cost statement. In case of the working capital components are given, then deduct this depreciation part from the respective inventory or debtors component or current liabilities component also. Generally, you can never find depreciation in the current liabilities. Okay. This is one important point you must remember. And also, while estimating the working capital requirement, You have to calculate investment in data. Always data should be valued at cost of sales, which is excluding depreciation. And I'm not taking profit also here. Generally, data should be valued at selling price. But for working capital requirement purpose, I'm going to take cost of sales. Sometimes I may take selling price also based on the assumption which is given in the problem. In case if there is a specific point in the examination problem that they are clearly mentioning, by clearly mentioning that data should be valued at selling price, then you should not calculate the data's value by taking cost of sales. Then data's investment in data must be calculated by taking selling price into consideration. Okay, these are the important points you must consider while estimating the working capital requirement. Should please keep it in mind always while solving the problems. Okay, with this, the first area called estimation of working capital requirement is over. Now I'm moving to the next area, calculation of net operating cycle. So what is this net operating cycle? Simple. Generally, if we invest money in the raw material stock, what will happen? You'll hold that raw material for a certain period. If you input such raw material into process, that becomes stock of work in progress. And it takes some time period to convert work in progress into finished goods. Then I'll get stock of finished goods. Then again, this finished goods will be held by the company for a certain period. Then after selling such finished goods, after holding certain period, then you'll get debtors. Then again, this debtors will take some time to, for every firm will take some time to collect these debtors or receivables, and finally I'll get cash. So cash will be converted to raw material stock, then work in progress, then finished goods, then debtors, and finally I'm going to get cash. So the question is, see, in this cycle, if you look at this cycle, this is a cycle which is known as which is known as operating cycle. You are holding the raw material for certain period. This is raw material holding period. You're holding the work in progress for certain period. That is work in progress holding period. You're holding the finished goods for certain period. That is finished goods holding period. And you're also holding the debtors for certain period. That is debtors collection period. If you add all these numbers, raw material holding period plus work in progress holding period plus finished goods holding period plus debtors collection period, the total is known as gross operating cycle period. Let me write the formula. Gross operating cycle period is equal to gross operating cycle period is equal to raw material holding period plus work in progress holding period plus finished goods holding period plus debtors collection period. This is my gross operating cycle period. If I remove creditors payment period from this, I'll get net operating cycle period. The formula is net operating cycle period. Net operating cycle period is equal to gross operating cycle period. OPCP means gross operating cycle period minus CPP, that means creditors payment period. This is a formula for net operating cycle period. So we have another formula, number of operating cycles. That means how many times I'm rotating the money, the working capital, number of operating cycles. Say for example, if you get net operating cycle period of 180 days, that means one cycle is taking 180 days. So how many cycles I can rotate in a year? Generally it is 2 cycles, because there are 360 days in a year. So for first cycle we are taking 180 days, then for second cycle I'm going to take 180 days. So finally within 360 days we can rotate 2 cycles. Okay, the formula for number of operating cycles is 365 days or 12 months or 52 weeks divided by net operating cycle period. Net operating cycle period. Okay. And also I can estimate the working capital requirement from this. Working capital requirement can be estimated even from operating cycle period also. The formula is cost of sales or operating cost divided by number of operating cycles. Number of operating cycles. This is what the formula for working capital requirement. Cost of sales or operating cost divided by number of operating cycles. The question is how to calculate this net operating cycle period. Raw material holding period, work in progress holding period, finished goods holding period, all these numbers must be calculated. I'm going to present that particular net operating cycle period in a statement. Calculation of net operating cycle period. Please remember this format, okay? Calculation of net operating cycle period. Yes. The columns are particulars, period in days. These are the standard columns. Particulars, period in days. The first formula is raw material holding period. Look at the first problem. I'm reading it. PQR Limited produces a product with the following revenue cost structure. Raw material cost per unit 115, direct labor is 80, overheads is 37, total cost is 232, profit is 58, selling price per unit is 290. So now look at the inventory norms. Average raw material in stock. That means raw material holding period is 1 month. Average materials in process, half a month. This is work in progress holding period. And we are taking 100% raw material, labor and overheads as 50% complete for work in progress units. Average finished goods in stock, finished goods holding period 1 month. Creditors allowed by suppliers, creditors payment period 1 month. Creditors allowed to debtors, debtors collection period 2 months. Time lag in payment of wages, half a month. Time lag in payment of overheads, 1 month. 1/4 of the sales are on cash basis. That means 3/4 are on credit basis applicable for debtors. Cash balance is expected to be 1,60,000. You are required to prepare a statement showing the working capital needed to finance an activity level of 60,000 units of annual output. This is what your budgeted production units. Budgeted production units. Budgeted production units. The production is carried throughout the year on even basis and wages and overheads accrue uniformly. Debtors are taken at cost. You have to consider cost for calculating investment in debtors. That's what the point you must remember. Now, already the cost statement is given and inventory norms are right away available. I can estimate the working capital requirement. I can prepare the statement directly. Look at the statement. Statement showing estimation of working capital. What is the first component? Investment in stock of raw material. What is the formula? Budgeted production unit 60,000 into raw material holding period is 1 month actually. So 1 divided by 12. Actually, we should write that number in the second leg actually. Now, the last one is raw material cost per unit. The study material, they have taken raw material cost per unit first, then they have taken raw material holding period divided by 12 months in the third component. Okay. So, instead of that, you can follow our format and write accordingly because it's merely a multiplication. A into B or B into A, both are same. Okay. Investment in stock of raw material. So, this will give you investment in stock of raw material. I'm taking 60,000 into raw material holding period 1 by 12 into raw material cost per unit 115. I got 5,75,000 investment in stock of raw material. Now investment in stock of work in progress. Budgeted production units into work in progress holding period divided by 12, 1 by 12 into raw material cost per unit. Actually, they have taken into 1 by 2 actually again. So let me multiply 60,000 into 1 by 12. Okay, fine. The work in progress holding period is half a month only. Okay. You better write your own formula instead of following this formula. I'll write like this. The raw material cost component which is included in work in progress is 60,000 units into 0.5 by 12. Why? Because that is half month period into raw material cost per unit is 115. That's enough. This will give you the number, by number. 60,000 into 0.5 by 12 into 115. I got 2,87,500. Coming to direct labor, the answer will be changed because actually for direct labor and overheads, it is only 50% complete. Okay. Then the formula will be 60,000 units into 0.5 by 12 into, okay, don't have enough space here. I'll write it here. Direct labor, 60,000 units into 0.5 by 12 into direct labor cost per unit. That is 80 into 50%. I should multiply 50% also. 60,000 into 0.5 by 12 into 80 rupees into 50%. I got 1 lakh. Yes, that's what we got it. Even for overheads also, you should write the formula like that. 60,000 units into budgeted production units into work in progress holding period 0.5 by 12 into overhead cost per unit into 37. Because it is blocked for 50% only, into 50%. I got, again, let me do it. 60,000 into 0.5 by 12 into wages, overhead cost per unit is 37, 92,500 into 50%. I got 46,250. That's it. Investment in stock of work in progress is successfully calculated by taking all the three cost components. In these three components, material is 100% complete, whereas labor and overhead is 50% complete. So if you get the total, you'll get 4,33,750. Now investment in stock of finished goods, how to get it? Budgeted production units 60,000 units into finished goods holding period, and that is 1 month into 1 by 12 into total cost per unit, and that comes to 232. That's what they've taken here. Yes, I got 11,60,000. Yes. Coming to data, investment in data. Take your estimated credit sales units. Out of 60,000 credit sales units, out of 60,000 sales units, they said what? 1/4 of the sales are on cash basis. That means 3/4 of the sales are on credit basis. So take the number 60,000 into 3/4 of the credit sales must be considered here because 1/4 is cash sales into debtors collection period is 2 months into 2 by 12, and debtors should be valued at total cost. My total cost is 232 per unit. So this is the number you have to do it. 60,000 into 3 by 4 into 2 by 12 into 232. I got 17,40,000. That's my investment in debtors. So, and also they've given cash balance, get the total gross working capital. This is ZWC, gross working capital. Deduct current liabilities from it. Now the first component is creditors for raw material. Take the budgeted production units, 60,000. Write the creditors payment period, 1 month divided by 12 months. Into raw material cost per unit, 115. I got 5,75,000. That's it. Creditors for wages, budgeted production units into time lag for wages is, actually the time lag for wages and overheads is same actually. No. Wages is half a month, overheads is 1 month. You better write your own calculation for outstanding wages. Let me take outstanding wages here. 60,000 production units, budgeted production units into time lag for wages is 0.5 by 12 into wages cost per unit is 80. That's it. 60,000 into 0.5 by 12 into 80. And I got 2 lakh rupees. 2 lakh rupees. This is my outstanding wages cost. Yes. Creditors for overheads. Yes. Outstanding overheads. The same formula. 60,000 units into. Actually, it is 1 month time lag only. So 60,000 into 1 by 12 into 37 rupees overhead cost per unit. That gives me what creditors are outstanding overheads are creditors for overheads. That is 1,85,000. Get the total of current liabilities and deduct it from current assets, gross working capital. Then I'll get what net working capital. In case if you have any safety margin, add it. Okay. With this, we understood how to estimate the working capital requirement. There are so many sums you can handle. Now I can go for the problems related to net operating cycle period. So in the next session, we are going to handle the problems related to net operating cycle period. Thank you. Good evening, all of you dear students. We have started with the chapter Working Capital Management. In that we understood the concept of estimation of working capital requirement and operating cycle period calculation. Now we are entering into the next area, management. So as part of that, I've started with receivables management. So in this receivables management or debtors management chapter, we are going to understand one important area called evaluation of alternative credit policies. That is our first area. That means, see, basically debtors will be generated or created by selling goods on credit basis and by allowing certain credit period to our customers. That means after selling the goods, we are going to give some amount of, certain period to our customers for paying their dues. Okay. So say for example, if we are giving 30 days time period to our customers for paying their dues, so that is one of our credit policy actually. So my dear students, while deciding this credit policy, about this credit policy, we should analyze two important factors, costs and benefits associated with the credit policy. So because we are always concerned with what? We are always concerned about the costs and benefits regarding our decision making. Okay. So while selecting this credit policy, we should select the best category of customers, selection of the customers, and also we should decide the amount of credit to be sanctioned. Nothing but, the worth of credit, worth of raw material, worth of finished goods can be sold to the respective customer. And the last one is the time period that we are allowing to our customers, nothing but the credit period. So the selection of the customer, credit sanctioning, nothing but the worth of the goods can be sold on credit basis to specific category of customers. And then the next one is credit period. That means the time period we are allowing to our customers for paying their dues. All these three things are part and parcel of our credit policy. But we are going to analyze the costs and benefits, the evaluation of costs and benefits associated with our credit policy, nothing but the credit period. So we need to discuss about the credit period, which is part and parcel of our credit policy. See, the organizations can follow several credit policies, and in such credit policies, say for example, right now the credit policy of the company is to allow 30 days to our customers for paying their respective dues. This is one of the credit policy. See, for this credit policy, I can get some amount of sales, and from that if I recover all my expenses, I'll get some amount of profit. This is my one of the credit policy. Now, the company is planning to change the credit policy, nothing but liberalize the credit policy by extending the time period to our customers for paying their respective dues. Say for example, right now we are allowing 30 days time period to our customers. Now we are planning to extend our credit period from 30 days to 40 days or 30 days to 50 days. Like that, that means I'm going to modify the credit policy. So for example, if this is policy 1, then 40 days will be your policy 2 and 50 days will be your policy 3. See, for these policies, I have to calculate the benefits and costs. Nothing but I should write the sales amount, nothing but the credit sales amount, and also I should write the expenses along with, with respect to each credit policy. Then finally, I must calculate my profit. See, for alternative credit policies, you have to calculate the benefits, nothing but the revenue, credit sales, and also the expenses, variable and fixed expenses, along with other expenses also. So if you recover such expenses from sales, ultimately I'm going to get net benefit. So I'm going to choose the alternative where my net benefit is maximum. So the first area is evaluation of alternative credit policies, nothing but selection of the best credit policies, selection of the best credit policy out of many policies in order to maximize our net benefit. So as part of that, I have to do what? Evaluation of alternative credit policies. We have a format for this, for evaluation of alternative credit policies. See, the format which is given in the study material is more than enough. That is very clear. I'm going to explain the format with the help of our study material. Okay, let me go for that. Yes, here is the format. Evaluation of the credit policies. Example 1. See, this is independent policy evaluation approach. We have two methods for evaluation of alternative credit policies. One is total approach. Another one is incremental approach. So let us start with the total approach. That means under total approach, for every policy independently, I'm going to calculate net benefit. So what are the standard columns under this approach? Under total approach, take the columns particulars, existing credit policy, Proposed policy 1, that means, if say for example in our discussion 30 days is our existing credit policy. Now we are planning to extend our credit period from 30 days to 40 days. So let us take the policy option 1, proposed policy 1. This is 40 days period. Proposed policy 2, 50 days period. Proposed policy 3, 60 days period. See, when I'm extending my credit period, what is the benefit I can derive? Simply, when I'm giving more time period to our customers, I can generate more sales. So the first area is credit sales will be increased. That's a benefit. So A, see, expected profit I need to calculate. First of all, let me write the credit sales. For every policy, I should write the credit sales. Generally, from one policy to one existing policy to policy 1, policy 2, policy 3, your sales is going to be increased. See, I'm not talking about cash sales here. I'm talking about credit sales only. Okay. So from credit sales, I must recover my expenses. Please write your total cost other than bad debts and cash discount. You please write this term also, other than bad debts and cash discount. So total cost, your total cost is loaded with two components, variable cost and fixed cost. Write the variable cost and fixed cost for the respective credit policies. Generally, the variable cost is the ratio of sales, whereas your fixed cost is a constant number. Write the numbers in the respective columns. Deduct such total cost other than bad debts and cash discount. Then you'll get profit before adjustment of bad debts and cash discount. You can write like that, or else you can live. Yes. I'll write it. That's better for us. Valuation of alternative credit policies. The columns will be particulars, existing policy, proposed policy 1, proposed policy 2. You can take policy 3 also, that's okay. Now, let me write the format. A, credit sales. Write the credit sales for the respective policy options. Now B, total cost other than bad debts and cash discount. Here is your total cost other than bad debts and cash discount. First, I must write variable cost, and then I should write fixed cost. Yes. If I deduct this total cost from my sales, I'll get profit before adjustment of bad debts and cash discount. You have to arrive this number. That will be A minus B. Okay. From this, please deduct your bad debts and cash discount. These two are two separate items. Write the bad debts and cash discount for the respective columns. Deduct it. Then I'll get profit before tax, income tax. From that, please deduct your income tax. Then I'm going to get profit after tax less opportunity cost of investment in debtors. This one we need to calculate actually. If you deduct this opportunity cost of investment in debtors, then ultimately I'm going to get net benefit. Yes. So after calculating, after arriving these net benefits for the respective credit policies, I'll adopt such credit policy where my net benefit is maximum. Okay. So I'll choose the alternative credit policy where my net benefit is maximum. Now the question is, sir, how to calculate opportunity cost of investment in debtors? Generally, this opportunity cost of investment in debtors This opportunity cost of investment in debtors can be calculated under three methods: based on sales method, or based on total cost method, and based on variable cost method. Let me write it. Opportunity cost of investment in debtors. First one, based on credit sales or sales. Second one, based on total cost. Third one, based on variable cost. The first approach is based on sales. See, based on sales means credit sales into debtors collection period divided by 365 days or 12 months into opportunity cost of capital. Okay, opportunity cost of capital. This is the formula based on sales. If you take total cost, the formula will be cost of sales or total cost into DCP divided by 365 days or 12 months into opportunity cost of capital. Okay, this is based on cost, total cost, or generally we are going to take cost of sales here. And based on variable cost, see, instead of taking total cost, I can take variable cost also. That is one of the method. So under variable cost method, the formula will be variable cost into debtors collection period divided by 365 days or 12 months into opportunity cost of capital. So this is the formula. So which method I must follow? See, my suggestion is, or even in the study material, always we are going to follow the second formula. That is credit cost of sales or total cost into debtors collection period divided by 365 days or 12 months into opportunity cost of capital. If you can use this formula, you can easily calculate opportunity cost of investment in debtors. So this is regarding total approach. Okay. See, we have another approach called incremental approach. My suggestion is you better follow total approach every time, if possible, unless the information is not available. See, in case if the information is not available, I must follow the incremental approach mandatorily. That's what the example 2 under incremental approach. Statement showing evaluation of credit policies based on incremental approach. So what is this incremental approach? Simple. Every time take the additional value. That's it. See, incremental expected profit. I've taken credit sales of every policy. Then what is my next job? I must calculate incremental credit sales. When you're taking incremental credit sales, you don't take present value, present policy value. Simply how to calculate incremental value. It can be sales or expenses, anything. Incremental value is equal to value under proposed policy minus value under existing policy. That's what the formula. I'm telling you, the formula for incremental value is incremental value is equal to, just checking here, incremental value is equal to value under proposed policy minus value under existing policy. This is a formula. If you take the sales under proposed policy minus sales under existing policy. If you take variable cost under proposed policy minus variable cost under existing policy. This is the formula, a simple formula. Everywhere you must apply this formula only. Now, let me go for that. Incremental credit sales. That means proposed policy 1 value minus existing policy 1 value. So, existing policy value. Proposed policy 1 value minus present policy value. So, that means credit sales under proposed policy 1 minus credit sales under present policy 1. So, where I should write? Here. That's my incremental credit sales with respect to policy 1. In the similar way for policy 2 also. Credit sales under proposed policy 2 minus credit sales under present policy. That will be my incremental credit sales with respect to proposed policy 2. Like that you have to calculate for even for policy 3. So once we get it, what I should do? Incremental cost of credit sales. How to calculate it? Write the variable cost. Write the fixed cost. Get the incremental value. Nothing but what? If you take variable cost under policy 1 minus variable cost under existing policy. Variable cost under policy 2 minus variable cost under present policy. Like that you have to write incremental variable cost, incremental fixed costs. Deduct the incremental total cost from your incremental credit sales, then you'll get incremental profit before adjustment of incremental bad debts and cash discount. So what is my next job? Incremental bad debts losses. So how to calculate incremental bad debts losses? Bad debts losses under proposed policy minus bad debts losses under existing policy. In the respective column, you have to write the numbers. Say for example, if you take the policy 1, write the incremental bad debts losses like this. Say for example, under policy 1, my bad debts losses are 1,50,000, whereas under my existing policy, my bad debts losses are only 1 lakh. Then you should write incremental bad debts with respect to policy 1 is 50,000. Okay, like that. You have to write incremental cash discount also. Then you'll get incremental expected profit after recovering these bad debts and incremental cash discount also. So once we get incremental expected profit, deduct tax from it, then I'll get incremental profit after tax. Then what is my next thing? I have to deduct opportunity cost of investment in data. Generally, even that number also should be calculated by taking incremental values. Nothing but opportunity cost of investment in incremental data. Okay. See, they've calculated like this. Required return on incremental investments. Cost of credit sales, right? The cost of credit sales for every column with respect to each credit policy. Collection period in days, write it. Investment in receivables. A into B divided by 360 or 365. Okay, A into B divided by 365 or 360. This is investment in receivables on the basis of revenue or on the basis of sale value. So, if you get investment in receivables, what is my next job? Incremental investment in receivables must be calculated. How to calculate incremental investment in receivables? Investment in receivables or investment in debtors with respect to policy 1 minus investment in receivables with respect to present policy is my incremental investment in receivables for policy 1. Again, repeating, my dear students. Write the cost of credit sales. I said cost of credit sales. That means cost of sales. Write the collection period for the respective columns. Calculate investment in debtors at cost of sales, not under sale value actually it is. It is on the basis of cost of sales. So investment in debtors on the basis of cost of sales. It is simply cost of sales into collection period divided by 365 days. That means A into B divided by 365 days. Or sometimes I can take 360 days also. Once we get investment in debtors, then how to calculate incremental investment in debtors? Investment in debtors for policy 1 minus investment in debtors for existing policy. Like that you have to calculate investment in incremental investment in debtors or incremental investment in receivables. Multiply such incremental investment in debtors with required rate of return. You please don't consider incremental required rate of return. Just take the required rate of return percentage. Apply such percentage on the respective incremental investment in debtors. Then I'll get opportunity cost of incremental investment in debtors. So this is what required return on incremental investment in incremental investments. Nothing but I can write here. Opportunity cost of incremental investment in debtors. That's what the term it is actually. So I'm taking incremental opportunity cost here. Okay. So once we get this incremental opportunity cost, deduct this incremental opportunity cost from incremental profit after tax with respect to policy 1, policy 2 and policy 3. Then I'll get incremental net benefit for policy 1, policy 2 and policy 3. Then select the credit policy where your incremental net benefit is maximum. That's it. This is one of the important approach. My dear students, some of the costing concepts should be applicable here. Nothing but I have to calculate variable cost per unit, and then from that you have to calculate fixed cost. Right? See, generally variable cost per unit is always constant, whereas your fixed cost total is constant. So here is the formula for calculating variable and fixed cost. Total fixed cost is equal to average cost per unit, nothing but total cost per unit. Deduct variable cost from it, then I'll get fixed cost per unit. My dear students, average cost per unit or total cost per unit is both are same. If you remove variable cost per unit from it, then I'll get fixed cost per unit. Then multiply such fixed cost per unit with number of units sold on credit under present policy. Multiply the fixed cost per unit with number of units sold under existing policy, then you'll get total fixed cost. Such fixed cost is applicable for every policy. And here is the formula for opportunity cost. Total cost of credit sales into debtors collection period divided by 365 days or 360 days into required rate of return, also known as opportunity cost of capital, divided by 100. It's a percentage in fact. Now let us handle one problem related to this concept. Illustration number 8. XYZ Corporation, whose current sales are in the region of 6 lakh rupees per annum and average collection period of 30 days, wants to pursue more liberal policy to improve sales. So while taking this liberal policy, they've taken some examples under this problem. So, okay, right now the existing policy is saying allow 30 days credit period to our customers. But now we are liberalizing the credit policy. That means extending credit period from 30 to 40, 30 to 50, 30 to 60 like that. Okay. A study made by management consultant reveals the following information. The selling price per unit is 3. The average cost per unit is 2.25. Variable cost per unit is 2. Now you can calculate fixed costs very easily. Average cost per unit minus variable cost per unit is fixed cost per unit. 2.25 minus 2 rupees. And that gave me 2.25 minus 2 rupees. That gives me 0.25. That is to be multiplied with your existing sales volume. 6 lakhs by 3 rupees selling price. That's my sales volume. 6 lakhs by 3 rupees is nothing but 2 lakh units. Into 2 lakh units, I got 50,000 fixed cost. That's my fixed cost. You can calculate fixed cost very comfortably. Just now I told you the formula. See, average cost per unit minus variable cost per unit into number of units sold under existing credit policy. So 2.25 minus 2 rupees is 0.25 into 6 lakhs by 3, 2 lakh units. I got a fixed cost of 50,000, which is constant for every policy, because even though the sales is increasing, it doesn't matter. Your fixed cost remains constant. Okay. Now, let me read the question. The current bad debts losses is 1%. Required return on additional investment is 20%. Assume a 360 days here. Which of the above policies would you recommend for adoption? Okay. We have some missing information in this problem. So write the bad debts percentage under all the policies. Existing policy 1%, proposed policy A 1.5, 2% for B, 3% for C, 4% for D. And also the credit sales for existing policy 6 lakhs. Policy A 6 lakh 30, 6 lakh 48, 6 lakh 75, 6 lakh 90,000. These numbers must be given in the problem itself. You can't take these numbers as an assumption. Okay. So there is a missing information. They're supposed to give these numbers. Unfortunately, that part in the problem is missed. Okay. And the study material. So now, which of the above policies would you recommend for adoption? Yes. Let me evaluate all these 4 policies. Actually, those 4 policies are not given here. In fact, the information is missing. Now I'm just taking the information here. Present policy 30 days, that was given. Option A, option B, option C, option D. 40 days, 50 days, 60 days, 75 days. This is the information which is missed in this particular problem, along with credit sales also. Now, You know the format, credit sales, write the credit sales in all the columns. Yes, when I'm extending the credit period from 30 to 40, my sales has been increased to 6 lakhs to 6,30,000. And if my credit period is 50 days, I'm increasing my sales from 6 lakhs to 6,48,000. That means my sales has been increased. Okay, like that, I'm taking credit sales under all the credit policies. Now I have to write total cost other than bad debts. So what is my first cost? Variable cost. You know that out of your total cost, 2 rupees is your variable cost. So simply out of 3 rupees selling price, 2 rupees is variable cost. 2/3 is my variable cost. You know the variable cost ratio formula, variable cost per unit divided by selling price per unit, 2/3. Okay, 2/3 is my variable cost. So 2/3, please apply 2/3 on your credit sales to get variable cost. So simply 6 lakhs into 2/3, 4 lakhs, 6,30,000 into 2/3, 4,20,000. Like that, you have to calculate variable cost for all the policies. Your fixed cost remains constant for all the policies, 50,000 only, no change in it. Deduct this total cost from credit sales, then I'll get profit before adjustment of bad debts and cash discount. You know, 6 lakhs minus 4,50,000, I got a profit of 1,50,000. That's my profit before adjustment of bad debts and cash discount. That was not given here. They've just taken total cost only, and then they have written bad debts, and finally they got expected profit because the cash discount is not available here. Okay, so like that, you have to calculate even for proposed policy A, get the total cost, deduct it from credit sales, then arrive the number profit before adjustment of bad debts. Then deduct this bad debts. You know the percentage of bad debts under existing policy is 1%. 6 lakhs into 1%, 6 lakhs into 1%, 6. Okay, 6,000, 6,30,000 into, for policy A, the bad debts percentage is 1.5%. Okay, into 1.5%, 9,450. Look at the numbers. Okay, then 6,48,000 into 2%, it is 12,960. And option C, 6,75,000 into 3%, that is 20,250. Okay, and then 6,90,000 into 4%, and that is 27,600. Deduct this bad debts from your credit sales. I mean, nothing but, yeah, from the profit before adjustment of bad debts and cash discount. Then I'll get expected profit before tax, that is PBT, this one. Okay, the tax rate is not given in the problem, so I'm just taking PBT as PAT. Okay, profit before tax is nothing but profit after tax. This is your profit after tax. Deduct this profit, deduct opportunity cost of investment in data from profit after tax, then arrive this net benefit. So how to calculate opportunity cost of investment in data? There is a separate working note here. Okay, look at this working note. Opportunity cost of average investment in data. I already told you the formula for investment in data is opportunity cost of investment in data is total credit sales into data's collection period divided by 365 days or 360 days into required rate of return, or it is also known as opportunity cost of investment in data. Okay, the opportunity cost percentage, or opportunity cost of capital percentage. Now, total cost, if you take the present policy, my total cost of credit sales is 4,50,000. Here is the number. This is my total cost of credit sales, variable cost plus fixed cost. Okay, 4,50,000 into data's collection period under existing policies 30 by 360. I'm taking 360 days in a year into opportunity cost of capital percentage or required rate of return percentage. The problem is 20%. Here is your required rate of return on your investment. So into 20%, 20 by 100. So I got a opportunity cost of 7,500 under existing policy. Coming to policy A, take the total cost of credit sales again, 4,70,000. 4,70,000 into data's collection period is 40 days. 40. See, 4,70,000 into my collection period is 40 days under policy A into 40 by 360 into opportunity cost of capital percentage is 20%. So I got a number of the opportunity cost of 10,444. Yes. Like that, you have to calculate for option B, option C, option D by taking 50, 60, 70 days respectively, and by taking the respective total cost of credit sales, and by multiplying what the opportunity cost of capital percentage or required rate of return. Okay. After deducting this opportunity cost from my profit after tax, I'll get net benefit, and choose the alternative way your net benefit is maximum. You know, the highest net benefit I can achieve is option A. So I'm going to adopt proposed policy A because it is going to increase my net benefit, because I'm going to earn higher net benefit as compared to other policies. Okay, you can write the conclusion like this: it is advisable to adopt option A because the net benefit is maximum. Okay. This is under total approach. Another method of solving the problem is incremental approach, if you remember. Okay. Here we assume that sales are on credit sales. Of course, all the sales given in the problem itself as credit sales. Otherwise, we cannot handle this problem. Okay. Now, under incremental approach, what is my first job? Write the incremental sales. Have you observed one thing? My existing credit sales is 6 lakhs. By choosing policy A, I'll get an additional sales of 30,000. B, 48,000. C, 75,000. D, 90,000. Simple. Option A, credit sales minus existing policy credit sales. That's what your incremental credit sales with respect to option A. 6 lakh 30,000 minus 6 lakhs. 6 lakh 48,000 minus 6 lakhs. 6 lakh 75,000 minus 6 lakhs. Like that, I have to calculate incremental credit sales. The same computation is applicable for every cost component here. Okay, along with revenue. Now, incremental variable cost. Simple. Take the variable cost. Incremental variable cost. Additional variable cost. Look at the numbers. 20,000. 32,000, 50,000, 60,000. Yes. And then finally, fixed cost. No incremental fixed cost is applicable here because everywhere my fixed cost is 50,000 only. Incremental bad debts. Yes. The first policy option A, bad debts 9,450 minus 6,000. That is 3,450. 3,450. Yes. Like that, you have to calculate bad debts losses for every policy separately. 6,960, 14,250 and 21,600. And deduct these bad debts from incremental. Deduct this incremental variable cost and incremental bad debts losses from incremental credit sales. Then you'll get incremental profit, expected profit. From this, you please deduct incremental opportunity cost of investment in data. How to get it? Your first job is to write in cost of credit sales for every policy. Already we got these numbers, total cost, variable plus fixed cost. And then calculate investment in data by taking these two numbers. Cost of credit sales into data collection period divided by 360 days. See, say for example, if you take the existing policy, 4,50,000 into 4,50,000 into 30 by 360, and that one is 37,500. Coming to policy A, 4,70,000 into 40 by 360, that is 52,222 minus 37,500 as my incremental investment in data. That is 14,722. Like that, you have to calculate investment in data with respect to all policies. Once we get it, then I can easily calculate incremental investment in receivables or data. That is simply investment in data under option A minus investment in data under existing policy. 52,222 minus 37,500. In the similar way, for option B, investment in data under option B minus investment in data under existing policy. That is 29,444. Like that, you have to calculate incremental investment in data with respect to option A, B, C, and then D finally. Okay. Once we get it, apply simply the percentage, the required rate of return 20% on the incremental investment in data. Then you'll get incremental opportunity cost of investment in data. Additional opportunity cost, nothing but. Okay. Required return on incremental investment is nothing but incremental opportunity cost on incremental investment in data. Nothing but additional cost of additional investment in data. Okay. So I got 2,944, 5,889, 9,167, 13,750. The simple term for this is incremental opportunity cost. That's simple. Okay, incremental opportunity cost, that is more than enough. Or you can write incremental opportunity cost of incremental investment in data. Okay. If you deduct this, then I'll get incremental net benefit. See, already we got the incremental profit 6,550 minus 2,944. 6,550 minus 2,944. I got 3,606. This is my incremental net benefit with respect to option A. In the similar way, you have to calculate incremental net benefit for option B, C, and D. And we got a highest incremental net benefit of 5,350 under option D actually. Okay, sorry. This is wrong actually. Let's write the numbers. 8,400 minus, this is a negative number. Okay. Let me write the numbers. For option D, it is 8,400 minus 13,750. It will be 5,350 negative. Okay. The only number which is maximum is option A. So either under total approach or under incremental approach, you should select only one policy. That is option A only. Okay. So since the incremental net benefit is higher for option A, I must adopt policy option A. Okay. The proposed policy A should be adopted since the net benefit is higher under this policy as compared to other policies. Okay. See, the third method, there is another method which is given in the problem. Another method of solving the problem is by computing the expected rate of return. See, here is the formula: incremental expected profit divided by incremental investment in debtors. So for example, if you take policy A, incremental net benefit, how much it is? 3,606 divided by, sorry, incremental net benefit. Sorry, that is incremental expected profit. Incremental expected profit divided by incremental investment in debtors, 14,722. So what is the formula? Incremental expected profit divided by incremental investment in debtors. 6,550 is my incremental profit, expected profit under option A. That is to be divided with what? Incremental investment in receivables, that is 14,722. Just now I told you. So it is 6,550 divided by 14,722. See, that is 44.49%. You have to calculate this expected rate of return for policy B, policy C, policy D also. My dear students, let me tell you one important point here. This formula should be solved. I mean, this formula should be applied only if it is specifically asked in the examination. My suggestion is don't follow this method. You better follow total approach. If the information is not sufficient enough to handle total approach, you better go ahead with what? Incremental approach. See, this third method should be applied only if it is specifically asked in the examination. That's my suggestion. Okay. Yes. In fact, this third method is an extension of second method only. Okay. With this, the debtors management part is completed. Now we can go for the next area called cash management. This is our next area, cash management. Under cash management, I should try to reduce the deficit balances. That means I should fill the deficit balances whenever required for the firm, and also I should identify the ideal cash balances and the respective periods, and that money should be invested in short-term securities or by mobilizing all the divisions money. Then I can invest such money in another new projects. Okay. See, generally in cash management, we have to handle these areas. You have to prepare cash budgets. And also you should understand optimum cash balance models. Optimum cash balance models. How much cash I should maintain? Optimum cash balance models. These are the two important areas I need to understand. Let me go ahead with the first area, second area called optimum cash balance models. Optimum cash balance. Also known as cash management models. Okay. See, this optimum cash balance is purely decided based on the demand for cash. The demand for cash can be certain or uncertain. If the demand for cash is certain, certain means even number, even outflows. If I say 365 crores outflow for the next year, then I'll assume that every day there will be 1 crore outflow. This is what even outflows, equal outflows. The cash demand for cash is certain. So in that case, yes. And the second one is if the demand for cash is uncertain or random. Uneven outflows. I'm not sure about where I'm going to incur huge expenditure and where I'm going to incur least expenditure. I'm not sure about it. The point of time is not certain. So when the outflows are unevenly flowing out of the organization, then that's the case of demand for cash is uncertain. In case if the demand for cash is certain, then I'll use a model called Baumel's model. Baumel's model of cash balance, or this is also known as inventory model. Inventory model. The next area is Miller-Orr model. In case if the demand for cash is uncertain, then I'm going to use a method called Miller-Orr model. Okay. Now let me talk about Baumel's model or inventory model. Under Baumel's model, or inventory model. There is a formula for optimum cash balance or optimum lot size. Optimum lot size. I'll give you a brief introduction regarding this. Optimum lot size is equal to C is equal to square root of 2FT by R. So what is this optimum lot size? Generally, every company will maintain their cash and cash balance and short-term securities like money market instruments, Indian treasury bills, certificate of deposits, intercorporate deposits, commercial papers like that. The short-term instruments should be purchased by the company whenever it is having some cash in the hand. So based on the requirements, that means based on the cash outflows in the organization, the cash disbursements in the organization, periodically it is going to sell the securities from its portfolio. And by liquidating such securities, it will get cash, and then by using such cash, it will meet its commitments. The company is going to meet its commitments. Now the point is, whenever you need money, at what rate I should sell my securities? Nothing but the lot size should be decided. Is it a larger lot size of security should be sold out, or a smaller lot size? That's what I have to decide. Actually, for the entire 1 year, I'm not going to sell one lot size. Why? Because if I sell huge lot size of securities for 1 year requirements, then what will happen? Unnecessarily, I'm going to maintain idle cash in my current account. There I cannot earn any interest. So if I fix a larger lot size which can meet 1 year expenses, I have to incur huge opportunity cost. Nothing but loss of interest on my securities. Or else if I choose 365 transactions, that means every day I'm going to sell my securities. So if I choose 365 transactions, if I choose a smaller lot size which can meet only day expenditure, then what will happen? Because of that, there will be huge transaction cost, because I need to execute 365 transactions for 365 days. That increases my transaction cost. So by minimizing this transaction cost and by minimizing this cash holding cost, nothing but opportunity cost of holding cash, average cash balance, I have to decide a better lot size which is known as optimum lot size. The formula for such optimum lot size is square root of 2FT by R, where F is equal to annual cash disbursements, nothing but annual cash outflows. Okay, annual cash disbursements. T is equal to cost per transaction. R is equal to interest rate per annum. Interest rate per annum. This is what F, T and R. And also I need to give you few formulas here. Number of transactions or transfers. Number of transactions or transfers is equal to annual cash disbursements divided by the lot size. This is just similar to UOQ model actually. Okay. Then transaction cost is equal to number of transactions into cost per transaction. Okay. And average cash balance is equal to lot size divided by 2, half of the lot size. Opportunity cost per annum is equal to average cash balance into interest rate on securities. Interest rate per annum. That means the interest rate that I can earn on my investments, or this can be rewritten as opportunity cost of capital percentage. Okay, sometimes I can use that particular percentage also. So this is my opportunity cost per annum. So my dear students, my total cost will be equal to transaction cost plus opportunity cost. These two numbers should be calculated for 1 year period. Okay, this is my total cost computation. Okay, fine, my dear students. Now the point is, let us apply this formula for the problem. Here is the problem 23rd. United Industries Limited projects that cash outlays will be 37,50,000 will occur uniformly throughout the coming year. This is what your F, annual cash disbursements. United plans to meet its cash requirements by periodically selling marketable securities from its portfolio. So the firm's marketable securities are invested to earn a return of 12% R, and the cost per transaction of converting securities to cash is 40 rupees. This is T. So use the Baumol's model to determine the optimum cash transaction size or optimum lot size of marketable securities to cash. Just now I told you optimum lot size is equal to square root of 2FT. They have used A instead of T. That's a simple notation difference. To square root of 2FT by C. Actually, we used R. Okay. Square root of 2FT by R. Square root of 2FT divided by R. So I can use square root of 2 into F, annual cash disbursements 37,50,000 into T, cost per transaction. It is 40 divided by R, 12%. 2 into 37,50,000 into 40 divided by 0.12 square root. It is 50,000. Yes. The optimum lot size is 50,000. So average cash balance. What will be the company's average cash balance? Lot size divided by 2. Just now I've told you that is 25,000. 50,000 by 2. How many transfers per year will be required? Number of transactions or number of transfers per year is equal to annual cash disbursements 37,50,000 divided by lot size 50,000. 75 transfers are required. And what will be the total annual cost of maintaining cash balance? See, transaction cost plus opportunity cost is my total cost. Transaction cost means number of transfers into cost per transaction. 75 into 40. Yes, 3,000. Opportunity cost is average cash balance into interest rate per annum. Average cash balance is 25,000 into interest rate per annum is 12%. Yes, I got 3,000. So total cost will be 6,000. Yes, with this we understood optimum lot size. So in the next session, we are going to understand Miller-Orr model. Okay, thank you. Good evening, all of you, dear students. In the last session, we understood Baumol's model or inventory model. Now we are moving to the next concept called stochastic model under cash management. Okay. Stochastic model or Miller-Orr model. This is the model name. And I need to fix the optimum cash balance. Actually, under this model, I'm going to fix different levels of cash balance because the outflows are always random here. The model itself is saying what stochastic. Stochastic means random actually. So this is being developed by Mr. Miller-Orr. So what we need to understand here. Yes. Under this model, we need to fix 3 levels of cash balance. One is upper limit. This is a maximum cash balance we can reach. And the second one is lower limit. This is a minimum cash balance we should maintain. The return point is the point where you should maintain the cash balance every time. That is a minimum. You have to maintain, the company should maintain the cash balance at return point only. That would be the optimum level actually. So, but due to random outflows, the cash balance keep on fluctuating. Sometimes it may reach upper point, sometimes it may reach lower point, and sometimes it may reach return point. Return point is the objective point. You should always try to reach there. That's the destination point. So what we should do? See, whenever the cash balance reaches the upper point, we should try to reach return point. So how it can happen? See, if the cash balance reaches upper point, you should buy short-term investments in the outside market. So it's nothing but you buying money market instruments. So by buying money market instruments, I can reduce my cash balance and gradually that reaches to return point. In case if the cash balance reaches to lower limit, then immediately you should sell enough number of securities to reach return point. Why? Because when the cash balance reaches to lower limit, I need more cash to maintain return point. So I need more cash to maintain the return level. So what I should do, simply I'll sell my existing securities in order to generate additional cash. So ultimately I can reach what the return point. So dear students, the question is, so what is the distance between this upper limit and return point and lower limit? First of all, fix these levels: upper limit, return point and lower limit. These are the three limits, and this is your horizon point. From horizon to lower limit, it is simply known as L. Lower limit is L. L is the distance from horizon to lower limit. Then from lower limit to return point, the distance is Z. And from return point to upper limit, the distance is 2Z. So here are the distances. One is horizon to lower limit, that is L, and lower limit to return point Z, return point to upper limit 2Z. Now the question is how to calculate this Z. So we have a formula for this Z. I'll tell you. Z is equal to cube root of 3TV by 4I. This is a formula you must remember. So what is the formula for Z? Z is equal to Z is equal to cube root of 3TV by 4I. But T is equal to cost per transaction V is equal to variance of daily cash flows. We need variance of daily cash flows. In case if the problem, if you can see standard deviation of cash flows, you please apply square to that. Why? Because variance is equal to standard deviation square. You know this formula. SD is equal to square root of variance. Variance is equal to standard deviation square. So V is equal to variance of daily cash flows. And I is equal to interest rate per day. Observe these terms actually. V is variance of daily cash flows. That means I need per day variance of cash flows. Whereas this I is interest rate per day. This is not interest rate per annum. Even if it is given in per annum terms, you must convert such interest rate into per day terms. Okay. Yes, this is interest rate per day. So we understood the formula for Z. Now along with this Z, we should also define few more formulas. L is equal to lower limit. You know that. And return point, R is equal to return point. The formula for return point is L plus Z. Yes, absolutely. You can see here. This is L plus Z. So the return point is simply lower limit plus Z. That's what the return point. Now the next formula is H, nothing but upper limit or upper point. What is the formula for upper point? Simple. From lower limit, you should add Z. Then after that, if you add 2Z, then ultimately from horizon to upper limit, I can get the distance. The formula is L plus Z plus 2Z, which can be rewritten as L plus 3Z. This is what my upper point. You must remember these three formulas. What are the formulas? L is equal to lower limit. R is equal to return point. H is equal to upper limit. H is equal to upper limit or upper point. The formula is very simple. L plus 3Z. And I can also rewritten and I can also write one of the formula called average cash balance. The average cash balance is nothing but the lower limit plus upper limit plus return limit. Nothing but lower point and upper point and return point. These three terms, average is nothing but average cash balance. L plus R plus H by 3. Upper point is nothing but higher point. So L means L, R means return point, L plus Z. H means upper point, L plus 3Z. Divided by 3. This is the formula for average cash balance. And from this I can write 3L plus 4Z. 3L plus 4Z divided by 3. Then I can write this formula as L plus 4 by 3Z. This is what the formula for average cash balance. The formula for average cash balance is L plus 4 by 3Z. Okay. So you must remember these formulas for handling the problems. Let me go for one of the problem related to this concept. Here is the problem. I'm just reading the problem. The management of X Limited has a policy of maintaining a minimum cash balance of 5 lakhs. See, this minimum cash balance is nothing but a lower limit. The standard deviation of the company's daily cash flows is 2 lakhs. Observe one thing here, dear students. They have not given variance of daily cash flows, despite they have given what variance standard deviation of daily cash flows. You need to apply what square to this term to get what variance of daily cash flows. The annual interest rate is 14%. This is interest rate per annum, but I need interest rate per day. Remember that. The transaction cost of buying or selling securities is 150 rupees per transaction. This is cost per transaction T. Determine the upper control limit, return point, and cash balance of X Limited as per the Miller-Rowe model. So I have to calculate upper point, return point, and I need to calculate average cash balance. That's what the cash balance. So how to calculate this? Simple. The formula is very simple. Z is equal to cube root of 3TV by 4I. This is what the formula for Z. So first you need to calculate Z term. Then once we get it, then you can easily calculate all these required terms called upper and return point and average cash balances. Let me do it. See, my standard deviation of cash flows are 2 lakhs. That's the term. Z is equal to cube root of 3TV by 4I. So first of all, T is equal to cost per transaction. That comes to the cost per transaction is simply 150 rupees. And I need variance of daily cash flows. How to get it? Simple. Standard deviation square. My standard deviation of daily cash flows is 2 lakhs. So it will be 2 lakhs square. Literally, I'm going to take this term. I is equal to interest rate per day. See, my interest rate per day, how I can get it? First of all, interest rate per annum is 14%, 0.14 into 1 by 365 days. Why? Because I need interest rate per day. 0.14 into, 0.14 by 365 days. It will be 0.00038356164. Yes. Let me write every number clearly here. Z is equal to cube root of 3 into cost per transaction 150 TV, variance of daily cash flows 2 lakhs square, 4 into I means 0.00038356164. Solve this number. Don't apply square to that 2 lakh term. Okay, we can use it. Cube root of 3 into 150 into You'll get error. That's okay. 450 into 2 lakh square divided by this term 4 into 0.0038356164. So this will be 0.0015342456. Okay. Then apply this. Cube root of 450 into 450 divided by number. I got 2,93,303. To 2 lakh square. So from this term, I need to calculate cube root actually. So it's pure mathematics. You should try to solve this. Let me do it in my own way. Cube root of, I can write this number as 2.93303 into 1 lakh. You can do it. And this 2 lakh square can be written as 2 into 1 lakh and 2 into 1 lakh. So see, just I can write this term as cube root of 2.93303 into 4 into 1 lakh cube. 1 lakh cube. So just take that number 1 lakh out of it. Then I'll get 1 lakh into cube root of 2.93303. 2.93303 into 4. So now you should calculate this cube root of 2.93303 into 4. That is 11.73212. One lakh into. So cube root of any number, we have one method, square root 15 times. This is step number 1. In step number 2, I have to calculate step 1 minus 1. Step number 3, step 2 divided by 3 plus 1. Step number 4, step 3 in, simple. Lastly, you have to calculate like this, into is equal to for 15 times. If you can apply this method, you can easily get this answer. So let me do it. 11.73212. 11.73212. Square root 15 times. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. Minus 1 divided by 3 plus 1 into is equal to 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. I got 2.723096. 2.2723096. 1506. Multiply this number with what? 1 lakh. I got 2,27,231. 227,231. let us look at the answer which is given in the study material, whether it is right or wrong. 2,22,227. We got 2,27,231. See, this is the approximate answer actually. Why? Because if you want to calculate cube root of any number, either you must apply logarithms or the number computation should be given in the problem itself. That means the value should be given in the problem. Then only we can get accurate answer. Otherwise, we can do this much only. So just follow my number, or else you can do one thing. You can follow the answer which is given in the study material. But there is no basis for this answer actually. Even in the study material, they've just given answer directly, not by giving any specific procedure. In the examination, I expect that the cube root number must be given in the problem itself. Then only we can solve the answer. We can get the answer. Okay. So that's my suggestion. Or else you can follow this formula. Okay. Or process that just now we have followed. So if we get Z, then you can easily calculate the other numbers also. Look at this. Upper limit L plus 3Z. 5 lakhs plus lower limit is 5 lakhs plus 3 into Z. Z is the number which is taken from your study material, 2,22,227. Instead of this, you can follow your own process, like just now we have followed cube root, how to calculate cube root of any number, square root 15 times minus 1 divided by 3 plus 1 into is equal to 15 times, like that. Okay. And return point, lower limit plus Z. That means 5 lakhs plus 2,22,227. And then average cash balance. What is the formula for average cash balance? L plus R plus H by 3, or else just now I told you we have one more formula, L plus 4 by 3 Z. That's what the formula they have applied here. L plus lower limit 5 lakhs plus 4 by 3 into Z, 2,22,227. Okay. In this way you can calculate, you can arrive the numbers. Okay. Yes. So we got this difference because of one reason. We have taken all decimals in the problem, like see here 0.0015342456. Whereas in the study material, maybe they have not taken all these decimals. Accordingly, they got different answer. Instead of 2,27,231, they got 222 some odd number. See, this difference arises because of approximation. I may take all decimals, or I may take 3 to 4 decimals. Accordingly, my answer will be changed. That is the only reason. This is also right answer. Okay. Follow this process strictly, because you don't have any other option if the number is not given in the problem. Okay. Application of logarithm is a difficult task, because applying logarithm, anti-logarithm, and referring such numbers in the table, and such table may not be available in the examination hall. So because of that reason, you better follow this process. This will give you full marks. Okay. Yes. Now let me go for the next concept under creditors management. Creditors management or payables management. Under payables management, we need to handle one of the aspect called cost of trade credit. This is one of the important area I must understand. So what is this cost of trade credit? Generally, whenever we are buying goods on credit basis, supplier will give us some time, like 30 days, 40 days, 50 days, like that. But if we are able to pay that particular due within a certain number of days, that means if they have given 30 days, instead of that, if you can pay the money within 10 days or within 5 days or within 6 days, the supplier may give you some discount called cash discount. And because of this cash discount, my payment will be reduced. So dear students, you should understand one thing here. Say for example, the supplier is giving one term like this, 2 by 10 net 30. This means he is offering 2% cash discount if payment is made within 10 days, whereas the normal credit period is 30 days. So dear students, the supplier is allowing 30 days credit period to all the customers for paying the dues. In case if any of the customer is willing to pay within 10 days, the supplier is ready to offer 2% cash discount. That means instead of paying 100 rupees, you can pay 98 rupees only. So what is saying actually, what is doing actually, he is indirectly charging some interest cost. Say for example, if you look at the term, the normal credit period is 30 days. If any of the customer is willing to pay the money or the due within 10 days, the supplier is ready to offer 2% cash discount. That means after 30 days, you are supposed to pay 100 rupees. Whereas just before 20 days, nothing but within 10 days, if you can pay the due within 10 days, that means just before 20 days, then you can pay only 98 rupees. Instead of 100, you can pay 98 only, because there is a discount of 2% cash discount. So instead of paying 100, you are just paying what? 98 rupees only. So if you are not willing to pay this due within 10 days, nothing but just before 20 days, you are supposed to pay 100 rupees instead of 98. That means indirectly the supplier is charging 2 rupees interest cost, which is technically known as cash discount. So this cash discount as a benefit to the customer if he is willing to pay immediately within 10 days. This cash discount as a cost to the company, is as a cost to the supplier. Nothing but it is a cost to the supplier if he's offering this cash discount to the customers. So dear students, indirectly this particular customer is paying what? This cash discount is in the form of interest cost. Why? Because if he is not willing to pay the money within 10 days, he is supposed to pay 100 rupees instead of 98. That means he is additionally paying 2 rupees money. This is technically known as cash discount, but in implicit terms, it is a interest cost. It is an interest cost. That means the supplier is indirectly charging interest cost to me. So dear students, what is happening here? See, either you can pay 98 or you can pay 100 rupees. So you have to calculate this 2 rupees cash discount cost into percentage terms. That's what the cost of trade credit. The cost of trade credit. Why? Because instead of paying 98, the customer is paying what? 100 rupees. So for this credit term only, he is paying 2 rupees cost. 2 rupees cost. Okay. That's what you have to convert this cash discount into a percentage. Cost of trade credit is equal to D by 100 minus D into 365 by N minus P into 100. This is a formula. What is this cost of trade credit? Simple. D is discount, where D is equal to discount. So I'm just calculating this cash discount term into per annum percentage terms. Okay, annualized percentage terms. D is equal to discount, nothing but cash discount. N is equal to normal credit period. This is a normal credit period. P is equal to discount period. That means within how many days you can avail this cash discount. If you are ready to pay the money within 10 days, then you can claim this cash discount. After 10 days, you cannot claim this cash discount. So this N is normal credit period 30 days and this P is discount period 10 days. See, discount availing period, that is also known as what? Discount availing period. So you can calculate cost of trade discount here. See, D is 2% cash discount, nothing but 2 rupees. D divided by 100 minus D means 100 minus 2 into 365 by N means normal credit period 30 minus discount period 10 into 100. This will give you cost of trade credit. So 2 by 98 into 365 by 20. I got 37.24%. This is what the annualized percentage cost. So indirectly the supplier is charging me 37.24% per annum if I am not willing to pay the money within the discount period. That means this is an implicit interest cost which is included in the purchase price of the raw material or the goods that I am buying. Okay. So dear students, this is what the cost of trade credit. Actually, under trade credit terms, you can never see the interest component because you'll buy the material, you'll pay the respective dues. But whereas there is an implicit interest cost which is loaded in the purchase price. That is nothing but cash discount. That is nothing but the cash discount which is being offered by the supplier whenever we are buying the raw material on trade credit basis. So such cash discount is an implicit interest cost that can be calculated in per annum terms by using this formula. D by 100 minus D into 365 by N minus P into 100. This is for a simple computation. We have another formula for this in case if you are following compounding basis. Whereas let's go for the formulas. Yes. Management of payables, I need to consider. Yes, here is the formula, and this is one of the application. A supplier of X Limited offers a company 2/15 net 40. So 2% cash discount, 15 days. This 15 days is discount this is P, discount period, and 40 days is normal credit period. To translate the shortened description of the payment terms, the supplier will allow a 2% discount if payment is made within 15 days. Regular payment of 40 days. Determine the cost of credit related to these terms. Just apply the formula and you'll get the answer. And they got 29.4%. The same computation just now we have done. Okay, nothing new here. No other new terms are applicable here. In case if you're considering the compounding effect, the same cost of trade credit can be calculated by using this formula. What is the formula, sir? 100 by 100 minus d whole to the power of 365 by t minus 1. This t is nothing but n minus p actually. This is n minus p. To be precise, the formula is 100 by 100 minus d whole to the power of 365 by n minus p minus 1. This is the formula actually. Okay. You know, dear students, this formula is applicable when the compounding effect is considered. That means if you consider the compounding effect, you should apply this formula. If you don't consider the compounding effect, then you can apply this a simple formula. Okay. So we don't have any problems related to this particular formula. So just follow these two formulas. Try to calculate the requirement based on the question which is given in the examination. Okay. With this, we understood cost of trade credit. Good evening, all of you, dear students. Our next concept in working capital management is inventory management. Okay. Actually, this particular concept is already covered in materials chapter under costing subject actually. But still, I'll give you a quick revision regarding this concept also, because you may get questions in this particular area also. Yes, the important areas that I'm going to deal in this particular concept is EOQ, economic order quantity, and total cost computation at EOQ. Third one, stock levels, fixing the stock levels, various stock levels. These are the three important areas I'm going to discuss. Along with that, we need to discuss inventory turnover ratios. Inventory turnover ratio. Yes, these areas we need to handle. Let me start with the first area called EOQ. Economic order quantity. See, dear students, whenever we are buying the raw material, there is a problem because we need to incur two important expenses called ordering cost and inventory carrying cost. Because to place an order, we have to incur some ordering cost, like giving advertisements, accepting tenders, selecting the best quotation, like that. And after that, once we get the raw material, bulk breaking cost, quality control cost, and then we have to incur so many expenses whenever we go for fresh order. So ordering cost is the cost which is related to placement of orders. Whereas inventory carrying cost means the cost which is incurred for carrying our inventory. See, after buying the raw material, that should be held by the company in the stock in the stores. See, when we are holding such particular quantity in the stores, we have to incur some expenditure like insurance cost, rent, and the cost. The funds, since the funds are blocked in the stock of raw material, I have to incur some opportunity cost, nothing but interest cost or dividend cost or average cost, which is average cost of funds blocked in stock of raw material. And we should also face losses, theft, pilferage, and other losses also. See, all these are the expenses to be incurred by the company because it is carrying some inventory. So the problem is we are going to incur another expenditure called purchase cost. Annually, every company will incur purchase cost, ordering cost, and inventory carrying cost. The point is, you should fix the ordering quantity in such a way that your total cost will be minimum. See, while fixing the best ordering quantity or the least cost ordering quantity, nothing but the economic ordering quantity, the purchase cost is always constant at any level of ordering quantities. That is one of the assumption under economic ordering quantity, EOQ. So we have to deal with these two expenses only, ordering cost and inventory carrying cost. See, if I need a 360 units raw material quantity in the next year, which is known as A, annual raw material requirement for the next year, then I should fix the ordering quantity. I can buy the entire quantity in one order so that my ordering cost will be reduced. But as I'm buying larger amount of quantity in single order, I'll incur huge inventory carrying costs unnecessarily. So you should not buy entire annual requirement in one ordering quantity. So you should fix the ordering quantity in such a way that the total cost should be minimum. So single ordering quantity may increase your inventory carrying cost. It will increase your inventory carrying cost, but it may reduce your ordering cost. If I buy single unit every day, then what will happen? Simple. Your ordering cost, if I buy one unit every day, what will happen? I have to place 360 orders in a year. That means I should incur 360 orders ordering cost, whereas my inventory carrying cost may be eliminated or it will be least. Okay. So if I fix the smaller ordering quantity, what will happen? The inventory carrying cost will be least. Why? Because I'm going to carry least quantity of raw material because I'm buying the ordering quantity in smaller lot size. But the problem is ordering cost will be increased because of more number of transactions. So I should not fix the smaller ordering quantity, or I should not fix the larger ordering quantity. I should fix the economic ordering quantity where my total cost is minimum. So that is objective of this concept, EOQ, economic ordering quantity. How I can fix this economic ordering quantity? The ordering cost should be minimum. The inventory carrying cost should be minimum. So that means I should equate these two expenses. So at EOQ, two expenses must be equal. That is ordering cost and inventory carrying cost. Ordering cost should be equal to inventory carrying cost, dear students. So what is this ordering cost? Simple. Number of orders into cost per order. What is this inventory carrying cost? The average quantity that you're carrying into ICC per unit per annum. For every unit, how much carrying cost you are incurring for 1 year period. That's what inventory carrying cost per unit per annum. How to get number of orders? Annual raw material requirement divided by economic order quantity. So 360 units that I'm going to buy, say for example, if my ordering quantity is 30 units, 360 by 30, 12 orders are required to be placed. Okay. Into cost per order. Your average quantity is nothing but EOQ divided by 2 on an average ordering quantity. On an average quantity into ICC per unit per annum. See, just take the numbers here. I'm not going into the depth because there are so many reasons. Even for EOQ by 2, there is a reason. After buying the ordering quantity, slowly you'll consume the raw material, and after certain period, it is going to become 0. So at the time of buying the raw material, I'll hold the full stock of raw material in my hand. But say for example, if it is going to be consumed within 30 days, so by the end of 30 days, the quantity in hand becomes 0. So at the time of buying, it is 30 units. At the time of, after consuming the entire quantity of raw material, it will become 0. So how many units I'm holding? Simply 30 plus 0 divided by 2. On an average, it is 15 units. So that's what the average quantity. 0 should not be considered. EOQ plus 0 divided by 2 or EOQ divided by 2. So that's what the logic behind this average quantity. On an average, how many units I'm holding? The entire quantity may not be held by the company throughout the period. Why? Because it is going to be consumed gradually. So you have to take the half of the average, half of the economic ordering quantity. That's your average quantity. So for every unit, how much carrying cost you are incurring, such inventory carrying cost will be loaded with so many expenses, insurance cost, rent cost, losses, theft, pilferage, and other evaporations, normal losses, and then what this particular interest cost or opportunity cost of funds blocked in stock of raw material. See, this inventory carrying cost can be expressed even in percentage terms also. You should remember that. Okay. Sometimes it can be given in rupees terms. Sometimes it can be given in percentage terms. So here is the term A, EOQ. Cost per order is denoted with O. ICC per unit per annum is denoted with C. See, A by EOQ into O is equal to EOQ divided by 2 into C. From this, EOQ square is equal to 2AO by C, where EOQ is equal to square root of 2AO by C. This is the formula for economic ordering quantity. The simple formula for economic ordering quantity is square root of 2AO by C. You know what is A? A is equal to, just now I told you, A is equal to annual raw material requirement O is equal to cost per order. C is equal to inventory carrying cost per unit per annum. ICC per unit per annum. Okay, I'm not writing this particular term fully. Inventory carrying cost per unit per annum. Yes, and also you need to remember few formulas. Yes, already I've given you. Ordering cost is equal to number of orders into cost per order. Number of orders is equal to annual raw material requirement divided by OQ, ordering quantity. That can be OQ or any other ordering quantity. Inventory carrying cost is equal to average quantity into ICC per unit per annum where average quantity is equal to OQ, ordering quantity divided by 2. Therefore, total cost is equal to ordering cost plus inventory carrying cost. Your total cost is generally not loaded with purchase cost. It is generally loaded with ordering cost and inventory carrying cost. This is inventory carrying cost. In case if discount rates are applicable for larger quantity of buying, then your total cost should be loaded with one more cost called purchase cost. Purchase cost plus ordering cost plus inventory carrying cost is the final cost. Okay. This is regarding EOQ, the concept of EOQ. And my dear students, I'm giving you the formulas for stock levels, various stock levels. Every firm should fix their stock levels in order to avoid stock out cost. Why? Because in case if the firm is not maintaining sufficient stock of raw material, then it may not support continuous production, and that means you may not produce the required production because of lack of raw material. So when the firm is maintaining insufficient stock of raw material, that leads to low production. That means you may not produce the required production. That leads to less sales, nothing but loss of sales. And finally, there will be a loss of profit. And such loss of profit because of non-maintenance of stock of raw material is nothing but stock out cost. To avoid such stock out cost, every firm should fix their stock levels. In such a way that stock out cost should be eliminated. Okay. So how to fix these stock levels? We have several stock levels. The first level is reorder level. I'm not going into the depth. Simply I'm taking the formulas. Reorder level is equal to maximum consumption into maximum lead time. You must remember these formulas. Lead time means it is the delivery period. After ordering the raw material, it will take some time to receive the raw material from the supplier. The time period which is being taken by the supplier for delivering the raw material is nothing but the delivery period or lead time, which is also known as reorder period. Okay. So the reorder level is nothing but the level at which I should go for fresh order. So at what level I should place a fresh order? Simply it is maximum consumption to maximum lead time. There is a logic behind this. We don't have enough time to explain that particular logic. So just go by the formula. Reorder level is equal to maximum consumption to maximum lead time. And the second point is safety stock or minimum stock level. Safety stock or minimum stock level is equal to reorder level ROL minus average consumption into average lead time. This is what the formula for safety stock or minimum stock level. So from reorder level, please deduct what the average consumption to average lead time in order to get safety stock or minimum stock level. That is the base level actually. Safety stock or minimum stock level is a minimum stock which is going to be maintained by every firm at any point of time. The third one is maximum, from this formula, actually, you can define one more formula called reorder level. ROL reorder level is equal to safety stock or minimum stock level plus average consumption into average lead time. This is what the formula for reorder level. Safety stock plus average consumption to average lead time. I'm writing the third formula. Maximum stock level is equal to reorder level plus reorder quantity ROQ minus minimum consumption into minimum lead time. See, if you consume the raw material for minimum lead time, and if your consumption is minimum, if the lead time is minimum, then finally you can reach the maximum stock level. So from reorder level, if the consumption is low, minimum, least consumption, if the lead time is least, then for such lead time, because of such least consumption, then after ordering the fresh quantity, generally after this lead time, I'm going to get this reorder quantity so that I can reach my maximum stock level. So from reorder level, I'll place a fresh order. That's what the reorder quantity. It takes some time to receive it. So if you reduce the minimum consumption to minimum lead time, nothing but what the consumption, the least consumption during least lead time. If you deduct that portion of consumption during this least lead time, minimum lead time, then immediately I'll get what the reorder quantity so that I can reach the maximum stock level. So how you can reach the maximum stock level? Because my consumption is minimum for this minimum lead time. In case if this consumption is average or maximum consumption, I may not reach this maximum stock level. So this maximum stock level arises only when your consumption is least and when your lead time is also least. Okay. Next, fourth one, average stock level. The formula for average stock level is maximum stock level plus minimum stock level divided by 2. This can be rewritten as safety stock plus half of EOQ. Half of EOQ. This is what the formula for average stock level. Okay. Yes. Now I'm going to the part, the content which is given in the material. The final level is danger level. I'm just reading the sentence. Danger level is equal to, what is the formula here? Look at the formula. Danger level is equal to normal rate of consumption. Dear students, normal rate of consumption or average rate of consumption, both are same. Average consumption to maximum reorder period for emergency purchases. So you please remember this formula also. Danger level is equal to average consumption into maximum lead time for emergency purchases. Maximum lead time for emergency purchases. I'm repeating the formula. Danger level is equal to average consumption into maximum lead time for emergency purchases. Okay. And I need to give you one more formula. That's what? The inventory turnover ratio. Here is the formula. Inventory turnover ratio is equal to value of material consumed during the period divided by value of average stock held during the period. So let me write the formula clearly. Raw material turnover ratio or inventory turnover ratio is equal to, the inventory is raw material. Inventory turnover ratio is equal to total raw material consumption, divided by average stock of raw material. Total raw material consumption is equal to opening stock of raw material plus purchases minus closing stock of raw material. And this average stock of raw material is equal to opening stock of raw material plus closing stock of raw material divided by 2. Okay. So this is what the formula for inventory turnover ratio. It shows how many times I'm rotating my average stock of raw material throughout the year. Okay. That's what the turnover ratio. Yes. With this background, let us handle small problems, a few problems here. Yes, the first area, EOQ and total cost computation. Here is a formula. Calculate the economic order quantity from the given information. Also state the number of orders to be placed in a year. Consumption of material per annum, this is A. Order placing cost per order, this is O, cost per order. Cost per kg of raw material, this is purchase price of the raw material. Storage cost is nothing but inventory carrying cost, 8% on average inventory. Apply 8% on your purchase price, 2 into 8%. I got C is equal to 0.16. That's my inventory carrying cost per unit per annum. So inventory carrying cost per unit per annum, C, can be given in rupees terms or it can be expressed as a percentage terms on the purchase price of the raw material. You should be very specific in this aspect. Why? Because the percentage can be given in month terms or in quarter terms or in annual terms. If it is given in annual terms, straight away apply such percentage on purchase price. If it is given in month terms, straight away apply such percentage on purchase price. After that, you should multiply that number with 12 months. Okay. So here is the formula. EOQ is equal to square root of 2AO by C. Square root of 2 into annual raw material requirement 10,000 cases into cost per order 50 divided by C. 2 into 8%. And that's what, that is, that's okay. No issue. I must get 2,500 cases. Square root of 2 into 10,000 into 50 divided by 0.16. Apply this. 2,500 cases. That's what the EOQ. And what is the formula for number of orders to be placed in a year? You know that A by annual raw material requirement divided by 10,000 cases divided by EOQ. That's 2,500. How many orders are required to be placed? 4 orders. Okay. That's it regarding EOQ computation. Let me go for the stock levels, the various stock levels I can fix. Here is the point. The consumption of A, the components of A and B are used as follows. Normal usage is 300 units per week. This is average consumption per week. Maximum use is 450 units per week. Minimum use is 150 units per week. Reorder quantity. Raw material A 2400 units. Raw material B 3600 units. Reorder period, which is also known as lead time, 4 to 6 weeks for raw material A, 2 to 4 weeks for raw material B. This 4 weeks is minimum lead time. The 6 weeks is maximum lead time. If you take the average 6 plus 4 divided by 2, I'll get 5. That is average lead time for raw material A. In the similar way, you should apply the concept for B also. Okay. Calculate for each component. Reorder level, minimum level, maximum level, average stock level. The same formulas. Let me show you the computation for raw material A. Reorder level, maximum consumption to maximum lead time. 450 is your maximum consumption into maximum lead time 6. This is maximum reorder period. The other name for lead time is reorder period. 450 into 6, 2700 units raw material. Okay. Maximum consumption 450, maximum lead time 6 weeks. Okay. A minimum level, reorder level minus average consumption to average lead time. So 2700 minus average consumption is simply, it is 300 units. Okay. 300 into average lead time is 5 weeks. So I got 1200 units. Maximum stock level, reorder level plus reorder quantity minus minimum consumption to minimum lead time. My reorder level is 2700 units. The reorder quantity, they told you that this reorder quantity is not given in the problem actually. They've taken 2400 reorder quantity, 2400 units. I guess, yeah, they have given. Reorder quantity for material A is 2400 units. That's okay. 2400 minus minimum consumption to minimum lead time. You know, minimum consumption is 150 units. Minimum lead time is 4 weeks. Now we got 4500 maximum stock level. Average stock level, maximum plus minimum divided by 2. Or safety stock, minimum stock level plus half of reorder quantity or half of EOQ. Economic order quantity or reorder quantity. It depends based on the information. Okay, ultimately you should write reorder quantity only. You better change the formula also because that's a simple one. Instead of writing EOQ, you better write ROQ because ROQ is a regularized term. That means the reorder quantity can be any ordering quantity. That can be EOQ or that can be some other quantity also. Okay. So finally, you know that maximum stock level plus minimum stock level divided by 2. 1200 plus 4500 divided by 2. Or safety stock, minimum stock level 1200 plus half of reorder quantity is 2400. I got 2400. In this way, you can fix the stock levels, my dear students. That's not a difficult job. Now coming to inventory turnover ratio, I told you already total raw material consumption divided by average stock of raw material. Compute the inventory turnover ratio from the following information: opening stock, closing stock, material consumed. The value of material consumed, that's what 7,80,000 divided by average stock of raw material 1 lakh plus 1,60,000 divided by 2. I got 1,30,000. So the turnover ratio is 6 times. It's a simple computation, nothing new here. Okay, nothing new. See, look at this problem, problem number 19. A company manufactures a special product which requires component alpha. The following particulars are collected for the year 2021. Annual demand of raw material alpha is 8,000 units, that is A. Cost of placing an order is O. Cost per unit of alpha is 400, that is purchase price. Carrying cost is 20% per annum, 400 into 20%, that I got 80 rupees, that's what C. The company has been offered a quantity discount of 4% on the purchase of alpha, provided the order size should be 4,000 components at a time. So the company is ready to offer 4% discount on the purchase price of alpha, provided the ordering quantity must be 4,000 components, not the economic ordering quantity. Compute the economic ordering quantity. That's a simple task. Square it of 2AO by C. And by applying that, they got 200 units. That's what EOQ. But the question is, can I advise whether the quantity discount offer can be accepted? Can I accept this quantity discount offer? So what I should do? I should calculate total cost under EOQ, economic ordering quantity, and under quantity discount offer of 4,000 units of ordering quantity. I got an EOQ of 200 units. So for the 200 units ordering quantity, I should calculate total cost. For 4,000 units ordering quantity, I should calculate total cost. Generally, total cost means ordering cost and inventory carrying cost. Purchase cost should not be considered because for any level of ordering quantity, the purchase cost remains constant. That is irrelevant for decision making. So I must consider ordering cost and inventory carrying cost. But in this particular area, if you observe the problem, they have given some discount rate. See, when the discount rates are applicable, the purchase cost will have an impact on your total cost, and that is going to affect your decision making. So I must consider purchase cost also. So my total cost is loaded with purchase cost, which is nothing but A into purchase price of the raw material, annual raw material requirement into purchase price of the raw material. The second one is ordering cost, number of orders into cost per order. Third one is inventory carrying cost, average quantity into ICC per unit per annum. Now look at the table here. When EOQ is ordered, I have taken purchase cost. 8,000 units of raw material I am purchasing into 400, 332 lakhs. Ordering cost and carrying cost. Ordering cost means A, annual raw material requirement 8,000 divided by ordering quantity EOQ 200. Number of orders are 40 orders to be placed into cost per order 200. 40 into 200, I got 8,000 rupees ordering cost. Inventory carrying cost means average quantity into ICC per unit per annum. Average quantity is half of economic ordering quantity. Half of economic ordering quantity means 200 divided by 2. That is 100 units. Into ICC per unit per annum is 80 rupees. Just now we have calculated. So 100 into 80, I got 8,000. Generally at economic ordering quantity, ordering generally means every time ordering cost at economic ordering quantity, ordering cost must be equal to inventory carrying cost. Okay. Finally, to get total cost, I must add three expenses: purchase cost, ordering cost, inventory carrying cost. Okay. In the similar way, you must calculate our total cost again at the quantity discount offer. Nothing but when the ordering quantity is 4,000 units. Okay. So there will be a change in the purchase cost. Why? Because I'm going to get some discount in the purchase price of the raw material if I buy the raw material in 4,000 units of ordering quantity, the larger quantity of raw material I'm going to buy. So 8,000 units I'm buying. That is a discount of how much percentage? 4%. The purchase price of the raw material is 400. 400 into, since the discount is 4%, 96% should be paid by the company. So I should pay 384 rupees. That's what the purchase price. On such 384 rupees only, you have to apply inventory carrying cost also. First of all, purchase cost. Annual raw material requirement is 4,000 units into the purchase price is 384 because of the discount. So I got 30 lakh 72,000. 8,000 units of raw material I am buying into 384, 30 lakh 72,000. Ordering cost. Number of orders into cost per order. 8,000 divided by 4,000. There will be two orders only. Into 200. I got 400 rupees ordering cost because of small, very fewer number of orders. Whereas the carrying cost, the carrying cost is nothing but average quantity into ICC per unit per annum. I am buying 4,000 units of ordering quantity divided by 2. This is my average quantity. 2,000 units I am holding into ICC per unit per annum. 384 is the purchase price this time. You should not take 80 rupees into. So 384 into 20%, 76.8. So 2,000 into 76.8. I got 1,53,600. Get the total. I got 32,26,000. So at what ordering quantity you got least cost? I got the least cost at the economic ordering quantity. So I must place the order by considering the EOQ. That means the EOQ should be 200 units. That's it. So the quantity discount offer should not be accepted because at the quantity discount offer, the total cost is higher. That is higher actually. Okay. I will reject the quantity discount offer. I'll go with the economic ordering quantity only. Okay. This is regarding the inventory management. We have two other areas in this particular area called working capital management. The second one is maximum permissible bank finance, MPBF. Okay. So the next concept is maximum permissible bank finance. Maximum permissible bank finance, MPBF in shortcut terms. We have three formulas under this MPBF. So what is this MPBF? The maximum finance can be sanctioned by every banker to the applicants or the borrowers, the corporate borrowers or any other individual borrowers. I mean, it should be fixed like this, MPBF. This is a maximum finance can be sanctioned by every banking company by following the norms of what the RBI. Actually, RBI has formed a committee called Tandem Committee. They fix these norms, they fix these methods, maximum permissible bank finance. That means any bank can sanction this much loan only for the borrowers who are seeking short-term advances in the form of bank overdraft or cash credit. This is purely for short-term bank loan actually. Okay, short-term bank loan in the form of cash credit and bank overdraft. So how much money can be sanctioned? How much short-term loan can be sanctioned by every banker to the corporate borrowers or any other kind of borrowers? And they should follow, such bankers should follow these methods which was suggested by Tandem Committee. Okay, MPBF, maximum permissible bank finance. There are three methods which were suggested by Tandem Committee. Method 1. Under method 1, MPBF should be equal to 75% of current assets minus current liabilities. That means 25% must be financed from long-term sources. Okay. So 75% of current assets minus current liabilities is a maximum permissible bank finance. It is a maximum permissible bank finance. So, and also while calculating this number, current liabilities should not be loaded with any kind of bank loans. Okay. Short-term bank loans should be excluded. Please calculate this MPBF. Then from that, please deduct your existing borrowing. Okay. Say for example, if I got 100 crores after calculating this number, and already have excluded the existing short-term borrowings from these current liabilities. That means while writing this formula, this current liabilities means current liabilities excluding ST borrowing, nothing but short-term borrowings. Okay. Yes. If you remove such short-term borrowings, you'll get the current liabilities. Deduct such current liabilities from current assets and apply 75%. That is the maximum permissible bank finance can be sanctioned by any banker to that particular borrower or any other borrower. So I got 100 crores. Already this particular company, say X Limited, is having one short-term bank loan, and thus that particular short-term bank loan is 55 crores. See, as per this norm, you can sanction, the particular banker can sanction 100 crores. Already we have 55 crores. So how much money the banker can sanction now? 100 minus 55, 45 crores can be sanctioned by the banker to this particular borrower. Because existing borrowing is 55 crores. The maximum permissible bank finance by any bank in the world or any bank in India is 100 crores. Whereas already the bank borrower is having one loan with 55 crores. Deduct that number from MPBF. The balance can be sanctioned in the form of short-term loan. Okay, this is what the method 1. 75% of current assets minus current liabilities. Method 2. You know, under method 2, MPBF is equal to, the formula will be changed, 75% of current assets minus current liabilities. Apply 75% only for current assets. Okay. So 75% of current assets minus current liabilities. Even here also, while considering current liabilities, you must exclude what the short-term bank borrowings in the form of bank overdraft or cash credit or any short-term bank loans. Okay. This is method 2. Under this method 2, this is somewhat complicated. Out of total gross working capital of current assets, 25%, 25% must be financed from long-term sources. The balance 75% can be sanctioned by the banker subject to deduction of current liabilities. This is what method 2. And method under method 3, the maximum permissible bank finances MPBF is equal to 75% of current assets minus core current assets CCA minus current liabilities. This is the formula. 75% of current assets minus CCA, core current assets. So you must apply current assets on this current assets minus core current assets. Then after that, you please deduct minus current liabilities. So my dear students, this core current assets is nothing but permanent working capital. The working capital that should be maintained by every firm throughout the year. Okay, this is a minimum level of working capital can be maintained by the company throughout the year. So deduct such permanent working capital. That means you please don't expect the permanent working capital finance from short-term sources. That means the company should finance that entire core current assets, the permanent working capital from long-term sources only. They should depend only on long-term sources, not on short-term sources. So deduct your core current assets immediately from current assets. Then out of the remaining temporary working capital, nothing but the after deducting permanent working capital from current assets, I'll get temporary working capital. Out of such temporary working capital, 25% must be financed from long-term sources. Then balance 75% can be financed by the banker subject to deduction of current liabilities. This is a complete interpretation of this third method. Instead of that, you better remember the formulas. See, I've given a lot of explanation here. It doesn't matter. You please remember the formulas itself. Method 1, 75% of current assets minus current liabilities. Method 2, 75% of current assets minus current liabilities. Method 3, 75% of current assets minus core current assets minus current liabilities. See, while taking current liabilities, please exclude bank borrowings. Once we get MPBF, deduct your existing borrowings. The balance is the money that I can get in the form of short-term bank loan from the banker. Or the balance is the money that can be sanctioned by every banker to that particular borrower. Okay, in aggregate must be considered here. Here MPBF doesn't mean that the loan can be sanctioned by one bank only. The MPBF is a money which can be sanctioned by all the banks in India to that particular borrower. That's what the norms which were given by Tandon Committee. Okay, you must remember that. Yes, with the help of this background, let me go for the problems. See, we can understand one problem here. Say there are some suggested current ratios also. The suggested current ratio under method 1 is 1:1, under method 2 is 1.3:1, and under method 3 is actually that was not given here. Actually, there is no suggested ratio for third method here. That's okay. Now, my dear students, let us go for the problem. 25th problem. I'm reading the question. Compute the maximum bank borrowing permissible under method 1, 2 and 3 of Tandon Committee norms from the following figures and comment on each method. See, we have raw material, work in progress, finished goods, receivables, including bills discounted with bankers and other current assets. Totally 740 is your current assets. Your current liabilities are loaded with creditors for purchase, other current liabilities, bank borrowing, including bills discounted with bankers. This is bank borrowing, short-term bank borrowing. You must exclude this. Okay. So we have only 300 lakhs worth of current liabilities. Okay. Excluding short-term bank loans. Now under method 1, what I should do? 75% of current assets minus current liabilities. So see, they have given some computation which is somewhat confusing actually. You better follow my calculation. The first method is what? 75% of current assets minus current liabilities. So method 1. MPBF is equal to 75% of current assets total. Just take the total. Total is 740 minus current liabilities 300. 740 minus 300. I'm not taking short-term bank loans. Why? Because those items should be excluded. 740 minus 300 into 75%, and the number is 330 lakhs. So as per method 1, the maximum permissible bank finance is 330 lakhs. Already the company is having a loan of 400 lakhs, whereas the maximum permissible bank finance is 330 lakhs. So, and there is an excess borrowing which is already available by the company is 70 lakhs. So what is the conclusion here? The maximum permissible bank borrowing under this method is 330 lakhs, whereas the existing bank borrowing is 400 lakhs. Therefore, the excess bank borrowing of 70 lakhs should be converted into term loan. So this particular company should not carry that number in the form of short-term bank loan. That particular banker should that particular company should immediately convert such 70 lakhs excess bank borrowing into term loan, so that it can satisfy the norms of what? Tandon Committee. Under method 2, 75% of current assets minus current liabilities. 75% of current assets, 75% into 740 minus current liabilities is 300 lakhs. Calculate this. 740 into 75% minus 300. I got 255 lakhs. This is what my maximum permissible bank finance. Already we are holding how much worth of loan? 400 lakhs. 400 minus 255. So 145 lakhs worth of short-term bank borrowing should be converted into term loan. The same logic. Okay. Under method 3, what is the formula? Current assets minus core current assets. 740 minus core current assets is simply, the core current assets portion actually. Just look at the number. The core current assets are 190 lakhs. Okay. So the formula will be 740 minus 190. This is my current assets minus core current assets into 75% minus current liabilities 300 lakhs. So simply 740 minus 190 into 75% minus 300. I got 112.5. They have taken approximately 112. That is the maximum permissible bank finance. Already there is an existing loan of 400 lakhs. So 288 lakhs should be converted into a term loan. With this, we understood what? This particular maximum permissible bank finance. We have one more area to handle here. That is what? The commercial paper. Have you heard about this term, commercial paper? Commercial paper is a short-term money market instrument that can be issued by any corporate borrower who is having better credit rating from the reputed credit rating agencies. Okay, so my dear students, so you must remember one thing: commercial paper is generally issued in larger denominations, say 5 lakhs, and there are some certain conditions should be satisfied in order to issue commercial paper. My job here is to calculate the rate of return can be earned by any investor who is purchasing the commercial paper. The feature of commercial paper is it is going to be issued at discount, redeemable at par. That's a short-term instrument. The maturity period is less than 1 year. Okay, it is going to be issued at discount, redeemable at par, face value. Okay, so the formula for the rate of return can be earned by every investor by buying this commercial paper, or interest yield, the rate of return or interest yield. That is the formula here. Face value minus sale price divided by sale price into 360 days by days of maturity. Maturity is nothing but the maturity period of that particular commercial paper. That can be 90 days or 180 days. It depends. Okay. So what is the formula for interest yield of the investor by buying this commercial paper? Face value of the commercial paper minus the sale price, nothing but the purchase price of the commercial paper divided by sale price. See, this is a sale price from issuer's perspective, and it is the purchase price from investor's perspective. That's okay. Face value minus sale price divided by sale price into 360 days by days of maturity, the maturity period of the commercial paper. Okay, so this is the formula. So look at the example. Suppose a firm sells 120 days commercial paper. See, 120 days commercial paper means this is my maturity period of the commercial paper. Okay, the face value is 100. For 96 net is nothing but sale price issued at discount. Generally, the commercial paper will be issued at discount. And the interest yield is 12.5%. Okay, they've taken some example actually. Generally, the face value of every commercial paper is 5 lakhs. Okay, so what is the formula? Face value 100 minus 96 sale price divided by 96 into 360 days divided by 120 days is my maturity period. So 100 minus 96 divided by 96 into 360 by 120 into 100. I got 12.499, nothing but 12.5%. That's my annual yield, annual interest yield by buying this commercial paper. See, sometimes, you know, this interest yield can be calculated in after tax terms also. If the tax rate is 35%, what is the formula? Interest yield into 1 minus tax rate. That's it. So 0.125, 12.5% into 1 minus 35% tax rate, I'll get 8.13% after tax interest yield. Okay, this is interest yield after tax. Interest yield after tax is equal to interest yield into 1 minus tax rate. See, we have a problem here. This is a standard problem. This is generally given in final also. XYZ Limited issued commercial paper as per the following details. Date of issue 17th December 2022. Date of maturity 17th March 2022. Size of issue 10 crores. This is a face value of commercial paper. Number of days is maturity period 90 days. Interest rate is 11.25% and face value is 100. Okay. What was the net amount received by the company on issue of commercial paper? First of all, they have applied this formula. What was that? Interest yield formula. Interest yield is equal to F minus SP, nothing but selling price divided by selling price into 360 days by maturity period. Already I know the interest yield 11.25%, 0.1125. 100 minus net amount realized, nothing but the sale proceeds or net amount realized divided by net amount realized into 360 by maturity period is 90 days. If you can solve this equation, you'll get one term called NP, net amount realized, and that one is 9.73 crores. Okay, so simply 0.1125 is equal to 100 is my face value minus net amount realized, which is the amount that is going to be received by company on issue of commercial paper, but sale price. Okay, minus SP, you can write sale price also, divided by sale price into 360 by maturity period 90 days. So the variable term is net amount received or selling price. If you can solve this equation, you must get 9.73 crores. Okay. Actually, the net amount received is how much? You'll get 9.73 rupees. Sorry, no. Let me solve this. They've taken this 10 crores money. (0.1125) into 90 divided by 360. 90 divided by 360. 0.028125 into net process is equal to 100 minus net process. then plus 1, 1.02818125, 100 by this number, I got 98.2644. 98.2644. So this is what the net process. So 10 crores divided by 100 into this number. So approximately I'm going to issue 10 lakh divided by, it will be 9.8263 crores actually. I got some wrong number. Okay. Let me calculate this net process in a different way. The face value of these commercial papers is 100 crores minus discount. The discount is nothing but interest. 100 crores into 11.25% into 90 by 360 days. Deduct this discount portion. Interest is nothing but discount. 100 into 11.25% into 90 by 360. 2.8125. 100 minus 2.8125 is, sorry, this is 10 crores. 10 into 11.25% into 90 by 360. Just a number computation. 0.28125. So 10 minus 0.28125. I got 9.718. Nothing but 9.72 or 9.73 crores approximately. Simple, my dear students. I'll give you the computation very clearly now. The face value is 10 crores. Deduct the discount in the form of interest for 90 days. Simply 10 crores into 11.25% into 90 by 360. This is the number you must deduct. 10 into 11.25% into 90 by 360. That's 0.28125. I got 9.71875, nothing but 9.72 crores. This is the net proceeds or net sale process. Okay, approximately they have taken 9.73 crores. Okay, dear students. So this is regarding the commercial paper computation, net process receivable on issue of commercial paper and the interest sale computation. With this particular chapter, working capital management is over. Thank you. Good evening, all of you, dear students. Our new concept, cash flow statement. Yes, here is our new concept, cash flow statement. The chapter name is cash flow statement. Here flow means cash. Here flow means changes. Cash means cash and cash equivalents. So we need to prepare a statement which shows the changes, either increase or decrease in the cash and cash equivalents from one balance sheet date to another balance sheet date. So the discussion is about one financial year actually. Okay. So from one balance sheet date to another balance sheet date, say 31st March 2023 to 31st March 2024. Okay. So from one balance sheet date to another balance sheet date, how the cash is flowing, how the cash is changing, whether it is increasing or decreasing. So you should check the cash and cash equivalents balance at the beginning of the year. And again, the cash and cash equivalents balance at the end of the year. So the cash can be increased or decreased. So you should identify the reason why the cash and cash equivalents are increased from one balance sheet date to another balance sheet, or decrease from one balance sheet date to another balance sheet date. So there are so many transactions which are the reason behind this, the change in the cash and cash equivalents from one balance sheet date to another balance sheet date. So all of such transactions must be presented in a statement called cash flow statement. So here, such transactions are classified into three parts. So such transactions, all of such transactions are classified into three parts. One, the cash flows from operating activities. This can be calculated, this can be prepared by using two methods. One is direct method. Another one is indirect method. Indirect method means you're going to calculate cash flows from operating activities from profit and loss account. Okay. So we just need to prepare a format. The second one is cash flows from financing activities. And finally, the last one is cash flows from investing activities. So this is what the way of understanding. We need to understand three areas: cash flows from operating activities, financing activities, and investing activities. Let me start with the first area, cash flows from operating activities. So I'm straight away going for the format which is given in the study material. That is very clear. You can follow the format which is given in the study material. I'm just explaining that format only. Here is the format, cash flow statement for the year. The first area is cash flows from operating activities, and this particular format is up to this direct method. This is your direct method. So what are the transactions I must consider for preparing cash flows from operating activities? The first one is cash receipts from customers. Cash receipts from customers means generally it is cash sales and collection from debtors. The second one is cash paid to suppliers and employees. Cash paid to suppliers and employees means cash paid to suppliers as part of cash purchases, cash paid to suppliers as part of creditors payments for credit purchases. Nothing but it is cash purchases and payment to creditors. And cash paid to employees means nothing but it is payment of wages and payment of salaries. And also you must consider other expenses like factory overhead expenses and admin and selling and distribution expenses. Any operating expenditure should be considered here if you are paying it in cash. Okay, so I can say one thing, COGS plus operating expenses must be considered here if such expenses are paid in cash. In case if such expenses are paid in cash and some of the expenses may be outstanding, such outstanding expenses must be adjusted, and you should calculate the payment. You should calculate the payment made during this period with respect to cost of goods sold and with respect to your operating expenses. Operating expenses means administration, selling and distribution expenses. So my dear students, cash paid to suppliers and employees means payment to creditors and cash purchases, and also payment of salaries and wages, and also other operating expenses must be considered here along with factory overhead expenses. And so finally I'm going to get cash flows from operations, cash generated from operations. So after getting the receipts from our customers and after paying all the payments related to suppliers and employees and other operating expenses, finally I'll get cash generated from operations. Then from such cash generated from operations, I must deduct income tax paid. Then finally, I'll get cash flows before extraordinary items. This is cash flows before extraordinary items. Then adjust your extraordinary items Extraordinary items may be a receipt or payment. So some of the extraordinary items can be found in some of the problems. So if such extraordinary item is a receipt, add it. If it is a deduction, just deduct it. Then finally you'll get what? Net cash flows from operating activities or net cash used in operating activities. Why? Because sometimes the balance can be positive or sometimes the balance can be negative. If you get positive, you're generating cash from operating activities. If it is negative, the cash has been used in this operating activities. Okay. See, this format is indirect method. I'm not explaining indirect method here because we have a separate format which is very specific in the study material itself. I'll explain the indirect method after completing this investing and financing activities. Now look at the next activities, cash flows from investing activities. So what are the investing activities? See, for cash flows from operating activities, you must refer your trading and profit and loss account, especially your trading account. Whereas in cash flows from investing activities, you must refer your asset side of the balance sheet. Nothing but what? Your assets purchase and your assets sale. Your investments purchase and your investment sale. So all of your investing activities must be considered here. Investment in fixed assets, investment in other long-term investments, and also sale of fixed assets and sale of investments. Any income if you're generating from investments, that should be considered here. Interest and dividend received on investments. So all these transactions must be considered here. Now look at the transactions. Individual items of cash inflows and cash outflows from financing activities. Oh, sorry, this is not financing activities. Investing activities. Investing activities. Individual items of cash inflows and outflows from investing activities. So what are those transactions? Such as purchase or sale of fixed assets. If it is a purchase of fixed asset, it's an outflow. If it is a sale of fixed asset, that's an inflow. Purchase or sale of investments. Purchase of investments reduces cash. Sale of investments increases cash. Interest received and dividend received on investments. These are the transactions in cash flows from investing activities format. Okay. Now go for the third transaction. Cash flows from financing activities. So what are the transactions in cash flows from financing activities? Financing activities means you have to consider the transactions like liability side of the transaction. So first we should refer trading account for calculating cash flows from operating activities, and asset side of the balance sheet for preparing cash flows from investing activities, and you should refer the liability side of the balance sheet for preparing cash flows from financing activities. So what are the transactions? So financing activities means either the transactions may increase your cash balance or it may decrease your cash balance. Issue of share capital, issue of debentures, long-term borrowings, issue of debentures, long-term borrowings, all these transactions will increase your cash balance. Buyback of equity, redemption of preference share capital, redemption of debentures, repayment of term loans will reduce your cash balance. Along with that, payment of dividend, equity dividend, preference dividend, payment of interest, and these payments will reduce your cash balance. So all these transactions must be considered here under the head cash flows from financing activities. Individual items of cash inflows and outflows from financing activities must be considered here, such as proceeds from issue of shares, long-term borrowings. So proceeds from issue of shares can be equity shares or preference shares. Long-term borrowings means you should consider every source like debentures, bonds, and other term loans from banks or other financial institutions or from private lenders. Okay. And repayment of long-term borrowings, that includes redemption of debentures, redemption of bonds, and repayment of term loans. Interest paid and dividend paid, etc. Dividend means equity dividend and preference dividend. So all these transactions must be considered here. So what are the transactions? Proceeds from issue of shares means issue of equity share capital, preference share capital. Long-term borrowings means issue of debentures, issue of bonds, and loans from banks and other financial institutions. Repayment of long-term borrowings means redemption of debentures, redemption of bonds, repayment of loans from banks and other financial institutions, interest paid, preference dividend paid, equity dividend paid. All these transactions must be considered in financing activities. Okay. So the net result can be this number, that is net cash from or used in financing activities. That's the sentence you must use here. So this is net cash, same sentence, net cash from or used in financing activities. The same sentence which we have used in investing activities should be used here. Why, sir? See, the financing activity can result in generation of cash flow, or it can result in use of cash flow. So if it is a negative balance, that's a use. If it is a positive balance, that's simply that is a generation of cash flow. Okay. So this is regarding all the transactions. So after preparing cash flows from operating activities, financing activities, and investing activities, what I should do? Then add all these numbers. All the three numbers must be added here. The first number, operating activities, financing activities, and investing activities. All the three numbers must be added here. The number may result in increase or decrease in cash and cash equivalents. This is what the net increase or decrease in the cash and cash equivalents. Then you should add cash and cash equivalents at the beginning of the period, nothing but at the beginning of the year. Then finally, I'll get cash and cash equivalents at the end of the year. See, this number is a net result of three activities: operating, investing, and financing activities. So some of the activities, all these three activities may not result in generation only. Sometimes some of the activities may result in application also, nothing but reduction in cash flow. So the net result of all these three activities is nothing but net increase or decrease in the cash and cash equivalents during the period. And to that number, you should add back what the cash and cash equivalents at the beginning of the year, nothing but the first balance sheet date. And then finally, I'll get what the cash and cash equivalents at the end of the year. That is what the balance at the end of the year on the closing balance sheet date. Okay. So this is regarding the format completely with direct method for preparing the statement cash flows from operating activities. Now let me go for the next statement called cash flows from operating activities under indirect method. See, my dear students, this is what the indirect method. This is going to be prepared from profit and loss appropriation account and profit and loss account. So by referring the profit and loss appropriation, profit and loss account, I can prepare cash flows from operating activities by adjusting some of the non-cash items and some of the non-operating items. So non-cash items should be added and non-operating items should be adjusted. Why? Because I'm going to prepare cash flows from operating activities only. So non-operating transactions should not be included in your cash flows. So this is a crucial statement because in most of the examinations, they'll ask you to prepare cash flows from operating activities under indirect method only. So it will be started like this: net profit before tax and extraordinary items, PBT. I can say this is PBT, profit before tax and before extraordinary items. Then add, what are the items I should add back? Non-cash and non-operating items which have already been debited to profit and loss account. So if any non-cash transactions were debited in profit and loss account, you please add it. If any non-operating items were added in this profit and loss account, please add it. Already I have explained what are the non-cash items and what are the non-operating items in funds flow statement. The same logic is applicable here also. So depreciation, that is your non-cash expenditure, add it. Transfer to reserves and provisions should be added. Transfer to reserves, like transfer to general reserve, a transfer to dividend equalization reserve, any reserve should be added back here. Transfer to provisions also. Provisions means provision for tax, like that. Okay. So goodwill written off. This is another non-cash item. Write off of goodwill is an intangible asset. Preliminary expenses written off. It is also another non-cash item. This is write off of fictitious assets. Other intangible assets written off such as discount or loss on issue of shares, debentures, underwriters commission, etc. See, these are not intangible assets. In fact, these are fictitious assets. So what are the fictitious assets? Write off of discount or loss on issue of shares. See, if you have any discount debit balance on issue of shares or issue of debentures, then such discount balance must be shown under the asset side of the balance sheet, which is gradually written off in the profit and loss account. That is nothing but amortization. Such amortization comes under non-cash expenditure only. And also write off of underwriters commission also. See, sometimes the underwriters commission gradually can be written off over the period. So in that case also, this write off of underwriters commission over a period of time is a non-cash expenditure. So what are the other non-cash expenses? Write off of discount or loss on issue of shares or debentures and underwriters commission, etc. So non-operating losses, loss on sale of fixed assets, loss on sale of investments. See, these two are non-operating losses or non-operating items. Why? Because selling fixed assets and selling investments is not my operating activity. Producing products and selling products is my operating activity. So if any loss arises because of selling fixed assets or selling investments, should be considered as non-operating transactions, and non-operating items must be added back here. Okay. Why? Because these transactions will be adjusted in investing activities. And then you know that depreciation, goodwill, preliminary expenses written off, and these are all, I mean, other intangible assets, nothing but fictitious assets written off. All these are what? Non-cash items or non-cash expenses. Non-cash expenses. Okay. So finally, one more loss is that foreign exchange loss. See, if you have any foreign exchange loss which is debited in profit and loss account, you please add it back. Then finally, the additions were over. Now I am going for deductions. Non-cash and non-operating items which have already been credited to profit and loss account. Some of the items which are credited in profit and loss account may not be in terms of cash. And some of the items which are already credited in profit and loss account must represent non-operating transactions. Those are not operating transactions like gain on sale of fixed assets, profit on sale of investments. These are what? Some non-operating gains. And also I'm going to get what? Some and also I'm going to get non-operating incomes like interest received and dividend received on my investments. These are my non-operating incomes. Why these are known as non-operating incomes? Why? Because I'm not here to earn income on my investments. If you have any surplus fund, generally companies are supposed to invest their surplus funds for shorter period of time in short-term investments, and gradually they can earn some amount of income. And also sometimes they can invest surplus funds in long-term investments also to earn some amount of income. Such income on investments is not an operating income. Why? Because suddenly we are going to liquidate those investments, and such money can be used for your expansion purpose also. So the ultimate thing for every business is to run their manufacturing activity or selling activity or trading activity, but not to invest money in the securities to earn interest income or dividend income, because you are not an investment company. So any income which is generated from investments is a non-operating income. So now let me write gain on sale of fixed assets. This is a non-operating gain or non-operating transaction. Profit on sale of investments, please deduct these two items. Okay, these two are what? Non-operating items. And also income from interest, income from investments, that can be interest or dividend, nothing but interest on investments and dividend on investments. These three are non-operating items, my dear students. Non-operating items. Some of these items are gains and some of these items are incomes, should be deducted. Appreciation, any asset appreciation which is credited in profit and loss account should be deducted. Why? Because such appreciation cannot increase your cash balance. Say for example, an asset has been appreciated and such appreciation was credited in profit and loss account, but such appreciation can increase your asset balance but not your cash balance. So you please deduct such portion also. And reserves, some of the reserves can be written off. Means some of the reserves can be written back. That nothing but what? If such reserves are not going to be used in the future, then such reserves can be written off in P&L account, can be created in P&L account. So if such reserves were created in P&L account, that is not a cash inflow. So you should not consider that reserves written back as a cash inflow. So such portion should be deducted, which is supposed to be deducted. And then foreign exchange gain, just like foreign exchange loss, which was added, which is already added. If you have any foreign exchange gain which is credited in P&L account, should be deducted here. Okay, these are the transactions. So what are the transactions? Gain on sale of fixed assets, profit on sale of investments, income from investments, nothing but interest and dividend received on investments, appreciations, any asset appreciations, reserves written back, and foreign exchange gains. So these items should be adjusted very carefully. Then finally, I'll get operating profit. Before working capital changes. We have a lot of adjustments here under indirect method. So finally, this is number I'm going to get. Then I'll go for adjustment for changes in current operating assets and current liabilities, nothing but current assets and current liabilities. Changes in current assets and current liabilities. The simple rule: if the current assets are increasing, that reduces your cash balance. If current assets are decreasing, that increases your cash balance. Okay. If current liabilities are increasing, that increases your cash balance. If current liabilities are decreasing, that reduces your cash balance. This is the rule. So what is the point here? There is a direct relationship between current liabilities and cash, and there is an inverse relationship between current asset and cash balance. So this is a rule. There is a huge logic behind this. and that is not at all required now. Just follow the format and logic, just follow the format and process what I'm saying. See, again repeating, increase in current asset decreases cash balance, decrease in current asset increases cash balance, increase in current liability increases cash balance, decrease in current liability decreases cash balance. That's the rule. Okay, nothing new. So now look at the transactions. Decrease in add, see the transactions are add, all these are additions. Decrease in account of current assets except cash and cash equivalents. You should not touch cash and cash equivalents. So decrease in accounts of current and current assets. When your current assets are decreasing, that increases your cash balance. So that's why we are adding these transactions. Decrease in trade debts, decrease in debtors, decrease in bills receivable, decrease in inventory and stock in trade, decrease in prepaid expenses. All these are what? Additions. Okay, you should add back. Now add few more items. Increase in accounts of current operating liabilities, nothing but increase in current liability except bank overdraft. Okay, increase in current liability except bank overdraft. So you should add few more items. Increase in current liabilities, increase in creditors, increase in bills payables, increase in outstanding expenses. I already told you the cash balance will be increased if there is a decrease in current asset or increase in current liabilities. Now look at these three transactions. These are increase in current liabilities, and the previous transactions are decrease in current assets. So these two transactions will increase your cash balance. That's why we have added here. Okay. Now the deductions. I told you already. Increase in current assets reduces cash balance less. Decrease in current liabilities reduces cash balance. That's it. The same transactions. Whatever we have written earlier. If such transactions are opposite, those are moving in the opposite direction, like increase in current assets or decrease in current liabilities, so such transactions will reduce your cash balance. Then finally I'll get cash generated from operations before paying income tax. Deduct income tax paid from it, then I'll get cash flows before extraordinary items, add or less. Such extraordinary items can be an addition or subtraction. Then finally I'll get what? Net cash flows from operating activities, or net cash flow used in the operating activities. This is regarding cash flows from operating activities under indirect method. You should be very careful while understanding this format, because there are so many transactions are adjusted here. So but in the problem you may not go through all these adjustments. Some of the adjustments can be given, some of the adjustments may be ignored. Accordingly you must prepare the cash flow statement. Okay, now let us understand two problems in this regard. Okay, look at 13th problem. Let's go for the 13th problem. I'm going to cover two problems under direct method and indirect method. Now 13th problem, this is regarding direct method. Very different problem which covers so many transactions. From the information contained in the income statement and balance sheet of A Limited, prepare cash flow statement. Income statement for the year ended 31st March 2022. Net sales less cash cost of sales. I can consider this cash cost of sales as cost of goods sold. Then deduct depreciation, salaries and wages, operating expenses, provision for tax. So finally we got net operating profit A minus B. So finally we are adding few more items here. Non-recurring income, profit on sale of equipment. Profit on sale of equipment means it's an asset. Okay, so after adjusting this item, 7,20,000 plus 1,20,000, it's an addition. Okay, then I got 8,40,000. Retained earnings and profits brought forward. This is your previous brought forward profit, 15,18,000. So finally after adding this number to 8,40,000, we got 23,58,000. Dividend declared and paid during the year. This is what the dividend declared and paid during the year. So after deducting this portion, I got profit and loss account closing balance. Okay. Yes. Balance sheets, opening and closing balance sheets, 31st March 21, 31st March 22. Fixed assets, in fixed assets we have land, buildings and equipment, and also we have current assets, cash, data, stock and advances. Liabilities and equity, share capital, surplus in profit and loss account, P&L account, credit balance, sundry creditors, other expenses, income tax payable. These are all current liabilities. Accumulated depreciation on building and equipment. This is provision for depreciation. Okay. Now, what we should do? Actually, we don't have any information regarding profit and loss appropriation account or profit and loss account here to prepare cash flows from operating activities under indirect method. Okay. I'm going to prepare this statement by using direct method here. Now, look at the transactions. See, for preparing cash flows from operating activities under direct method, I need what? Cash receipts from customers and cash payment to suppliers and employees and other expenses also. So, some of the working notes are supposed to be prepared. First one, cash receipts from customers. You can prepare debtors accounts to get what? The collection from debtors. Instead of that, they've done like this. Sales revenue, for sales revenue, they've added opening balance and they've deducted closing balance. Finally, they got what? Collection from debtors. Instead of that, you can prepare debtors account. Write opening balance, write closing balance, write the sales under credit side. Sorry, write the sales under debit side, debtors to sales. Then you'll get a balancing figure under credit side. That's what by bank. That's what your collection from debtors. You'll get 2 crore 50 lakh 20,000 as your collection from debtors. But by preparing a debtors account, that's a simple task. Income tax paid. Just like in funds flow statement, you have to prepare provision for tax account or income tax payable account. Write the opening balance, write the closing balance, and provision should be written under credit side. I'll prepare it once. The provision for tax account. Just like this. Provision for tax account. What will do? Write the opening balance by balance brought down. This will be 1,20,000. Write the closing balance, to balance carried down. That's my closing balance, 1,32,000. And write the current year provision, which is already given in your income statement. Provision for taxes 8,80,000. That means that's your current year provision by P&L account. Profit and loss account to provision for tax account. That's my current year provision 8,80,000. So if you get the total under credit side, the debit side balance will be of payment of tax. 1,20,000 plus 8,80,000. It is 10 lakhs minus 1,32,000. I'll get 8,68,000 payment. See, instead of preparing account, they've prepared what? A statement to bank. This is your current year tax payment. Okay. Then the next working note is cash paid to suppliers and employees. See, this is a crucial statement. You should be very careful. First of all, I'm taking all expenses here. Cost of goods sold, the first item, 198 lakhs, which is taken from income statement. Cost of goods sold, and I'm going to take operating expenses also along with salaries and wages. That's what I'm doing here. Look at the transactions, operating expenses and salaries and wages. See, operating expenses are, your operating expenses are 8 lakhs, salaries and wages are 24 lakhs. Totally it is 32 lakhs. Okay, 32 lakhs I've written here. 24 plus 8, actually those numbers are given separately. 198 lakhs plus 32 lakhs. I got 230 lakhs. This is what the amount which is debited in P&L account. That doesn't mean that the payment has been made for 230 lakhs. Why? Because out of this expenditure, some of the expenses may be outstanding. Some of the expenses we can have opening balances with respect to some of the expenses. So such transactions must be adjusted here. Why? Because I need actual payment related to this cost of goods sold, operating expenses and salaries and wages. You should be very careful. This cost of goods sold includes what? The raw material stock, and that is purchased, and cash purchases, credit purchases, everything will be included in your cost of goods sold. So you should refer your balance sheet items. See, there are some additions here and subtractions also. I'll explain every addition and subtraction, why we are adding and why we are deducting. The first transaction that I'm adding here is creditors at the beginning. Sir, why you are adding creditors at the beginning? Why? Because these 24 lakhs are the creditors outstanding at the beginning of the year, nothing but the opening creditors balance. And for this amount, I should make payment in this year only. Okay. So payment to creditors should include 24 lakhs. So the opening creditors must be paid in the current year. Otherwise, they don't accept it. So payment of creditors, actually this opening creditors for 24 lakhs. For this 24 lakhs, maybe payments purchases were made in the previous year. So the point is, such payment should be considered here only. in this year only. So I'm adding this number. So why you're adding 24 lakhs? Why? Because opening creditors must be paid in the current year, and that number 24 lakhs is not loaded in this 198 lakhs. Okay. Hope you got it. So opening creditors were added and stock at the end were added 9,60,000. So why you're adding stock at the end? Because this 9,60,000 is already adjusted while calculating cost of goods sold. Why? Because the formula for cost of goods sold is opening stock plus purchases minus closing stock. I've subtracted closing stock, but the point is such closing stock, for such closing stock, already I make payment in the current year. So the point is the closing stock at the end of the year should be added here. Why? Because for this 9,60,000, I should make payment in the current year. I should make payment in the current year. So such payment should be added here. Okay. This is another transaction. So opening creditor must be paid in the current year. That's a cash outflow. Closing stock might have purchased in the current year. That's a cash outflow. So should be added. And advance at the end. See, advance at the end. I got advance at the end only if I can make payment. So I made a payment of 90,000, which is not shown in this particular expenditure balance. So 230 lakhs is not including, that is not included with this advance paid. Why? Because this 230 lakhs is considered as on the basis of accrual concept. So that will never include any advances which were paid in the current year. So advance at the end should be added. Outstanding expenses at the beginning should be added. Just like opening creditors, opening outstanding expenses must be paid in the current year. So should be added. So these are the reasons why we are adding all these transactions. Again, I'm repeating, creditors at the beginning should be added because I'm going to make payment for this year. In this year, stock at the end should be added. Why? Because for such the closing stock is also one of the purchases. For that I should have made payment, so that should be added. And advances at the end, so for that also already I made payment, so that is also one of the cash outflow which is not included in 230 lakhs. And outstanding expenses at the beginning of the year should be added here. Why? Because such outstanding expenses were not yet paid in the previous year, and we are going to make payment for such payment in the current year. So these are all additions that I got 36,90,000. And then finally the deductions, the payments, creditors at the end. So why you are deducting 23,40,000 from this total number of 230 lakhs? My 230 lakhs is loaded with creditors at the end. Why? Because the creditors at the end is representing purchases. For that, I have never made payment in the current year. So I should deduct that number 23,40,000. So just like how you are adding opening creditors, the closing creditors should be deducted here. This creditors at the end of the period represents purchase of raw material, which is already included in 230 lakhs. For that, I never made any payment, should be deducted. So stock at the beginning. See, opening stock is already loaded in 230 lakhs. 230 lakhs is nothing but if you take this 198 lakhs cost of goods sold, opening stock plus purchases minus closing stock. Opening stock, for opening stock, I don't need to make payment in the current year. Why? Because that is already a purchase stock in the last year. They have paid payment. They made payment in the last year itself. So you should not add back such item. We should not include that item in 198 lakhs. So for that reason, opening stock should be deducted because for opening stock, already we made payment in the last year. Okay, this is the reason why I'm deducting opening stock here. Advance at the beginning. See, advance at the beginning represents payment we made payment in the last year. So since we made payment in the last year, that should be deducted here. Why? Because you don't need to make payment for this advance in the current year. So this advance is an advance expenditure in the last year, prepaid expenditure, and accrual expenditure, nothing but what the concerned year expenditure of this year that is already been included in this 2 crore 30 lakhs. Okay. So advance at the beginning should be deducted. So how you have added advance at the end earlier, in the similar way, advance at the beginning should be deducted. Why? Because the payment is made in the last year. Okay. Outstanding expenses at the end of the year, 4,80,000 represents 4,80,000 expenditure have incurred but not yet paid. So this is already included in 230 lakhs. So it should be excluded. Why? Because these transactions never involves any cash outlay in the current year. So you have to deduct those transactions. So after adjusting this, I got total cash paid to suppliers and employees successfully. And this transaction is a regular transaction, accumulated depreciation on equipment sold. See, you know that if you can prepare asset account and provision for depreciation account, you can simply close these two accounts actually. They have prepared one statement. Accumulated depreciation at the beginning of the year. At the beginning of the year is 12 lakhs. And this is another transaction. Add depreciation for the year is 6 lakhs. Current year depreciation. So for opening provision for depreciation, I'm adding current year depreciation. So my closing depreciation should be 18 lakhs, 12 lakhs plus 6 lakhs. This, it should be the closing balance 18 lakhs. So it should be the closing balance 18 lakhs. Whereas the closing depreciation at the end of the year, the provision for depreciation at the end of the year is 13 lakh 20,000. What was happened here? 18 lakh minus 13 lakh 20,000. That means 4 lakh 80,000 provision for depreciation has been reduced. Generally, the provision for depreciation will be reduced only when you're transferring such portion of provision for depreciation relating to sold asset. Nothing but this 4 lakh 80,000 is accumulated depreciation relating to sold asset. That should be transferred to asset account, and there only the transaction will be closed. So this is your accumulated depreciation relating to sold asset. Now, the sale price of equipment. You know that the cost of the asset which was sold is 7 lakh 20,000. On that, I have provided 4 lakh 80,000 accumulated depreciation. So the book value of such asset, the equipment sold, the book value of equipment sold is 2 lakh 40,000. So 2 lakh 40,000 is the book value of equipment which was sold for profit, and that profit is 1 lakh 20,000. If you add profit to your book value, I'll get what? The sale value 3 lakh 60,000. Generally, the book value, when the sale value is more than book value, that results in what? The profit. So if you deduct sale value minus book value, I'll get what? Profit. Or I can write sale value plus book value. Sale value plus profit is equal to, book value plus profit is equal to sale value. Book value plus profit is equal to sale value. So by comparing two numbers, sale value and book value, I'll get profit. Sale value minus book value is profit, or otherwise book value plus profit is equal to sale value. So we got sale value by adding profit to your book value. Okay, how you got book value? Cost of the asset, equipment minus accumulated depreciation provided on it, 4 lakh 80,000. Then I got what? 2 lakh 40,000 book value. To that I've added profit. I got sale value of fixed asset or equipment. Purchase of building and equipment. You can prepare building and equipment account, write the opening balance, write the closing balance, and write the equipment sold transaction along with profit. Then the debit side balancing figure will be purchases, 28 lakh 80,000. Write the equipment, building and equipment account, debit side opening balance, closing balance, write the sale transaction. Then automatically the debit side you'll get what? The balancing figure, purchases of building and equipment. That's a simple transaction. I'm not explaining. Okay. Now you please look at the statement. Cash flows of A Limited for the year ended 31st March 2022. So what are the transactions? Cash receipts from customers. Just now we got it. 2 crore. Cash receipts from customers. 2 crore 50 lakh 20,000. Then cash payment to suppliers and employees. 2 crore 11 lakh 52,000. That's your second working note. Third working note. This is the transaction. 2 crore 11 lakh 52,000. That's my payment to suppliers and employees and other operating expenses also. I got cash generated from operations. Please deduct income tax paid from provision for tax account. Then I'll get what? Net cash flows from operating activities. Then investing activities. Purchase of land, purchase of building and equipment, sale of equipment for 3 lakh 60,000. So these are the only three transactions. We don't have any interest received and dividend received incomes. So purchase of land. So how you got purchase of land? Just look at the asset account. Land opening balance 4 lakh 80,000, closing balance 9 lakh 60,000. So your land balance has been increased from 4 lakh 80,000 to 9 lakh 60,000. I'm assuming that such additional 4 lakh 80,000 is the purchase of land. Okay. Now that's your investing activity. Then the next one is purchase of building and equipment. See, already we have prepared this working note. Purchase of building and equipment is 7 lakh 20,000. That's the transaction. That's a 7 lakh 20,000. Building and equipment. Okay, fine. Purchase of building and equipment. Here is the payment. 28 lakh 80,000. Okay. Then sale of equipment 3 lakh 60,000. So after adjusting all these three transactions, we got 30 lakhs uses. That's what the net cash used in finance. This is not financing activity. Investing activities. It's a spelling mistake. A word mistake. Investing activities. It's a uses. Now cash flows from financing activities. Look at the liability side of the balance sheet. Liability side of the balance sheet is clearly mentioning share capital has been increased. That's an issue of share capital. Along with that, we don't have any long-term borrowings or other adjustments were not given here. We have only one transaction, issue of share capital. Then dividend payments and interest payments must be considered here if you have any debt balance. Okay. Now Look at the transaction. Issue of share capital, the difference is 8,40,000. I paid dividend. So how you got dividend payment? Just look at the profit and loss account. Dividend paid during the year 7,20,000. That's what your payment. So deduct such dividend payment here. That's a financing activity. Apart from that, we don't have any other transaction like redemption of preference share capital, redemption of debentures, repayment of term loans, or other issue of share capital, issue of preference share capital, issue of debentures, long-term borrowings. No such transactions were given here. The only two transactions under financing activity or issue of share capital, but that is the difference between opening and closing share capital balance, and dividend paid, that was taken from your income statement account. Okay, that was taken from income statement, not account. So we got 1,20,000 generation. So operating activity results in 30 lakhs generation, financing activity results in 1,20,000 generation, and usage is 30 lakhs in investing activity. So finally that results in 1,20,000 additional generation of cash. This is what net increase or decrease in cash and cash equivalents. It's a net increase in cash and cash equivalents. My opening cash and cash equivalents balance from the balance sheet, I can say it is 6 lakhs. 6 lakhs plus 1,20,000. I got 7,20,000. Okay. 6 lakhs plus 1,20,000. I got 7,20,000 cash and cash equivalents at the end. This is regarding direct method. Now let us go for problem number 14. This is an indirect method. Balance sheets of a company as on 31st March 2021 and 2022 are as follows. Goodwill, intangible asset, land and buildings, plant and machinery, fixed assets, investments, stock, debtors, cash and bank balance, prepaid expenses. All these 4 items are current assets. Premium on redemption of debentures it's a fictitious asset. Okay, this is a fictitious asset. Opening balance nil, closing balance 20,000. So this is generated during this year. Okay. Equity share capital, preference share capital, general reserve, securities premium account, profit and loss account, credit balance, 11% debentures, creditors, provision for tax, proposed dividend. These are the transactions. We have some adjustments also here. Investments were sold during their sale of investments, sale of machinery, depreciation charged on plant and machinery, no purchase or sale of land and building, provision for taxation made during the year. You have to prepare what? Preference shares were issued for consideration of cash during the year. You are required to prepare cash flow statement and schedule of changes in working capital. Generally, you have to prepare all the possible accounts, then only you can prepare cash flow statement. First, you should prepare land and buildings account, then you should prepare plant and machinery account, then you should prepare investments account. By considering all these adjustments, you have to prepare all the relevant accounts. Then you can prepare cash flows from operating activities, financing activities, and investing activities. The point is, you must follow indirect method here. Okay. So there are some accounts were prepared here. First one is provision for tax account, opening balance, closing balance, and this is what the current year provision 96,000 by P&L account, provision for tax. So 71,000 becomes your balancing figure. This is what the tax payment. 71,000 must be considered in your cash flows from operating activities as payment of tax. Investment account. So I'm just explaining directly by seeing these accounts. Investment account. You please look at the transaction. Investments were sold during the year at a profit of 15,000. Opening investment balance is 2,40,000. Closing investment balance is 2,20,000. So the difference is 20,000. So 20,000 cost of the investments were sold at a profit of 15,000. So the sale value must be 35,000. 20 plus 15. That's what they've done. By bank 35,000, the profit is credited to profit and loss account and a debit side of the investment account to profit and loss account or profit on sale of investments account. Okay. Then the next account is plant and machinery account. Write the opening balance, write the closing balance, then go for the accounts. Plant and machinery 6 lakhs, 60,000. Do you have any provision for depreciation account here? So that means this plant and machinery account is prepared at book value. That means already the provision for depreciation is deducted from the opening and closing balances. Now look at the transaction. Depreciation charged on plant and machinery is 20% on the opening balance. Look at the transactions. Opening balance of plant and machinery is 6 lakhs. 6 lakhs into 20%. I got 1,20,000 depreciation. That was the current year depreciation by depreciation account. Now we have an adjustment here. Sale transaction. Now look at the transaction. During their old machine costing 80,000 was sold for 36,000. Its written down value was 45,000. So 45,000 book value of the asset was sold for 36,000. Minus 36,000, it results in a loss of 9,000. Okay, so I can write like this. By bank the sale value 36,000. The loss should be debited to profit and loss account. By P&L account, the loss on sale of plant and machinery account. The sale transaction was closed. Opening balance we have written, closing balance we have written, current year depreciation has been provided, and sale transaction is closed. So the debit side balancing figure must represent your purchases. I got a balancing figure of 2,25,000. You can prepare this account. You can easily get a debit side balancing figure of 2,25,000. That's your purchase. Generally in Asset account, you should have opening balance, closing balance, current year depreciation, sale transaction, purchase transaction. We have from the data we got what opening and closing balances, sale transaction, current year depreciation. That means the debit side balancing figure must represent your purchases. That's it. So apart from that, we don't have any other adjustments. We have a few adjustments, small adjustments. We can straight away refer those transactions from the balance sheet. Okay. Now I'm going to prepare cash flows from operating activities. Directly I'm explaining this calculation. First, I must start with what? Profit before tax, and they are trying to get it. Okay, profit and loss account as on 31st March 2022. This is my closing balance. Profit and loss account as on 31st March 2021. This is my opening balance. The difference is profit after tax and after appropriations. This is PAT and appropriations, my dear students. Okay, this is not PBT. So I must add all appropriations which were made in profit and loss appropriation accounts. That is transferred reserves and transferred reserves, proposed dividend. These two are the real-time appropriations from profit and loss appropriation account. Transferred to general reserve. Look at the general reserve account difference. 1,20,000, 1,45,000. The difference is 25,000 general reserve. This is the money which is transferred during the year. So transferred to general reserve is 25,000. So that should be added here. Yes. And proposed dividend. You know that closing is the current year appropriation and opening balance is the current year payment. So 1,44,000 must be appropriated in the current year. 1,36,000 is the last year appropriation. Payment should be made in the current year. Okay. So look at the transaction. 1,44,000 is the current year appropriation, should be added back. Okay. So these two are appropriations. And also along with that, I'm adding provision for tax, also current year provision for tax. So why? Because I need to get PBT, not profit after tax. So after adjusting these two appropriations, transferred to reserves and proposed dividend, current year appropriation of proposed dividend was added, and transferred to general reserve was added, and also I've added provision for tax that is made during the period. Provision for tax account. Closing balance is the current year provision, opening balance is current year payment, unless if you have any adjustment here. You know that provision for tax made during the year, that was directly given in the problem itself. 96,000 is the current year provision, which is debited in current year P&L account. So should be added back to get PBT, profit before tax. From this, I should follow the regular format. What are the adjustments? You know that adjustment for depreciation. Land and building depreciation 50,000. Plant and machinery depreciation 1,20,000. These two are non-cash transactions. Apart from such non-cash transactions, I should also refer intangible assets and fictitious assets. We have one goodwill. Opening 1 lakh, closing 80,000. The difference 20,000 is current year write-off. That is 20,000 goodwill written off. So that should have been added here. See, here is the number 20,000. That is one more non-cash item. Yes. Depreciation is over. And then I can go for non-operating items like profit on sale of investments. 15,000 should be deducted. Loss on sale of land and machinery should be added. Okay. Interest on debentures. I'm assuming that debentures were redeemed at the beginning of the year itself. We have opening balance of 5 lakhs, closing balance of 3 lakhs. So the debentures were reduced to the extent of 2 lakhs. So such 2 lakhs were redeemed. So I'm assuming that such debentures were redeemed at the beginning of the year. So that means only for the balance 3 lakhs only, I should pay interest for the whole year. 3 lakhs into 11%, 33,000 is my interest payment that was debited in profit and loss account. That's my assumption, which is given in the study material. Look at this 33,000 interest on debentures that is debited in current year P&L account, and that's a payment for the current year. Okay. So finally we got operating profit before working capital changes. Okay. See, we have adjusted every transaction here, non-cash items, non-operating items, and then what? Interest expenditure also. Then finally, before working capital changes, you please go through the working capital changes. Prepaid expenses were decreased, stock is decreased, debtors is increased, creditors were increased. See, decrease in prepaid expenses, decrease in stock, increases cash balance, positive. Increase in debtors, increase in debtors reduces cash balance, minus. Increase in creditors increases cash balance, plus. We got cash generated from operations. Income tax paid is 71,000. By preparing provision for tax account, you'll get payment of tax of 71,000. I'll get net cash flows from operating activities. Then after that, Your financing and investing activities are regular transactions. Sale of investments 35,000. Sale of plant and machinery 36,000. Purchase of plant and machinery 2,25,000 deduction. So positive minus plus, I got 1,54,000 negative balance. That means investing activity is not generating cash. In fact, we are using cash for investing activities. From financing activities, we have issued preference share capital of 1 lakh. And also we have received some premium on issue of securities. How you got it? You please go for the account. Equity share capital, yes, preference share capital. Equity, there is no change in equity share capital, no issue of equity share capital. Preference share capital is increased by 1 lakh. That means we have issued preference share capital of 1 lakh. And also we have received some securities premium. So while issuing preference share capital, I got some securities premium. That means I think the preference share capital were issued for premium. So 1,25,000 is the right number. They have separated those two numbers. Okay. They've separated those two numbers. Okay. Issue of preference share capital, issue of premium on issue of securities, and redemption of debentures at premium. How you got it? Redemption of debentures at premium. You know that debentures were redeemed to the extent of 2 lakhs. You made such redemption at premium or at par value, we don't know. But by seeing the balance sheet, I can see one transaction, premium on redemption of debentures. We don't have any opening balance, but we have a closing balance. I got some closing debit balance just because I'm redeeming the debentures at a premium of 20,000. So that's very clear. So for the face value of redemption of 2 lakhs, I should add back what? 20,000. 2,20,000 is redemption of debentures along with premium. That's an outflow. Dividend paid is 1,36,000. Opening balance paid. I guess opening balance paid. Closing is appropriated actually. And interest paid on debentures is 33,000. Finally, we have uses in financing activities also. So after adjusting all these three transactions, I got net increase in cash and cash equivalents because we got highest positive balance in from operating activities 4,23,000. Investing activities 1,54,000. 423,000 minus 1,54,000. 269,000, and financing activities minus 2,64,000. Finally, we got 5,000 increase in cash and cash equivalents, and cash and cash equivalents at the beginning of the year is 83,000, 88,000. So you got a closing cash and cash equivalents balance of 93,000. Okay. And also they have asked you to prepare schedule of changes in working capital. The columns are opening, the particulars, opening balance sheet, closing balance sheet, changes in working capital. Schedule of changes in working capital. This is not a cash flow statement. This is changes in working capital. Write the current assets, write the current liabilities. Okay, write the current assets and current liabilities. If your current asset is increasing, that's an increase in working capital. If your current asset is decreasing, that reduces working capital. If your current liability is increasing, that reduces working capital. If your current liability is decreasing, that increases working capital. So you should not compare these transactions with your cash flow changes. Okay. See, this is completely a different aspect. I'm repeating, for schedule of changes in working capital. See, working capital means fund. This is regarding fund flow. Okay. The statement is purely related to funds flow. So my observations, my statements now are not applicable to cash flow statement. Already earlier I have explained what increase in current asset increase in current assets reduces cash balance, decrease in current asset increases cash balance. That is an inverse relationship. Increase in current liabilities increases cash balance, decrease in current liabilities decreases cash balance. That's what I've explained. But now this statement is completely different. The application is completely different. Okay. Increase in current asset increases working capital. Decrease in current assets decrease in working capital. Increase in current liability decreases working capital. Decrease in current liability increases working capital. Here the relationship is different. Current assets and working capital are directly related. Current liabilities and working capital are inversely related. That means increase in current assets increases working capital. Decrease in current assets decreases working capital. Increase in current liabilities decreases working capital. Decrease in current liability increases working capital. That's what we are doing here. Stock, it has been decreased. So stock has been decreased. That reduces working capital. Decrease in working capital. Debtors is increased. Debtors are increased. That means that increases working capital. Like that you have to write increase or decrease. In a similar way, creditors are decreased. Sorry, increase in creditors reduces working capital. Decrease in working capital. In case if your creditors were decreased, what could have been done? I should do increase in working capital. So current liabilities increase, decreases working capital. Current liabilities decrease, increase in working capital. So accordingly, you should write net working capital opening, closing. So I can say from opening to closing, my working capital has been increased. Increase in working capital is 83,000. I got the total of 6,89,000, 6,89,000. In the similar way, write all the totals of increase in working capital, decrease in working capital also. Actually, 15 plus 4 and 30. 30 minus 30 plus 19,000. It is 49,000. In case, whereas increase in working capital is 132,000, decrease in working capital is 49,000. So 132,000 minus 49,000, I got 83,000 increase in working capital net balance. So this is a format which should be prepared very carefully. Okay. With this, the cash flow statement is over. See, it's all about preparing accounts and preparing adjustments. So with my limited time, I've explained every point as much as possible. You please try to prepare every account, and you should prepare every adjustment, every working note very carefully. Why? Because these sums will take longer time to understand. I've explained with a high speed. It doesn't matter, just to understand the content. You better prepare these problems very carefully by preparing every working note. You should start with assets and you should end with liabilities. Then only you can prepare all accounts thoroughly. Only after preparing accounts, after preparing all working notes, you can prepare cash flow statement. Remember that. Okay. With this, the cash flow statement is over. Thank you.